Question resale price method ആണ്. Question number 6 അല്ലേ? Question number 6, right? Yeah. So while doing resale price method, there is a small point you have to keep in mind. First, what we are doing is at what price it has been purchased from related party and then resold in India to the ultimate customer. That ultimate customer in India is unrelated party. So that price is the starting point. So originally it is imported from a related party and sold it to unrelated party in India. From that resold price, what we are reducing is normal gross profit margin in a comparable uncontrolled transaction. That means a similar goods has been imported from unrelated party abroad and has been resold to unrelated parties in India. So it is actually a similar transaction to the first one. So from that, what is the normal gross profit margin that we are reducing? So by reducing the unrelated parties gross profit margin from this price, what we are getting is the price that would have been paid if it is purchased from an unrelated party. So that is the actually price we are getting at that point of time. From that related purchase expense from a related party has to be reduced from that price, so that what we are getting is the price which will be similar to that purchase from an unrelated party from abroad. So next we are adding or less the adjustments to account for differences. So that may be some difference in import expenses or discount or something like that. So that differences while considering, you should think about comparable uncontrolled price method, where what we are doing is compare the related party transaction with unrelated and both are making at the same level. So similar type of adjustments we are doing at the last stage. So then we will get the arm's length the purchase price. So here we can see that question. So AE1 Limited is an Indian company. AE1 Limited is an Indian company. The shareholding pattern of AE1 Limited is as follows. Shareholders name, foreign company. So it's very clear here. The related party is AE2 Limited, foreign company in which AE1 Limited is holding 30% shares. That is a AE. AE1 Limited trade in compact disc writers. AE1 procured CD writers both locally and in the international market. It imports consist of CD writers purchased from AE2 as well as another manufacturer known as. So this is the related party transaction, that is importing goods from AE2 Limited and then it is resold in India. AE1 Limited during the year purchased 100 CD writers from AE2 Limited at rupees 2,900 per unit. So this is TP transfer price. These are resold to A Limited at a price of 3,000 per unit. So that this 3,000 is the starting point of our computation. AE1 Limited has also purchased similar product from an unrelated supplier, that is K Limited, and has resold the same to M Limited, who is also an unrelated party and has earned a normal gross profit of 12% on sales. So actually in this question, related party and unrelated party transaction, material differences has not been given. So it's a very simple question. Simply follow the steps mentioned in rules, how we will value. So first take the price, that is resale price at which it is resold to customers, that is from AE and resold it to unrelated party in India. That price is rupees 3,000 less. From this 3,000, reduce the normal gross profit marker on the sales which is originally purchased from unrelated party, imported from unrelated party and resold to related parties in India. So that is in this case 12% on sales. So less normal GP margin in a comparable uncontrolled transaction, that is 12%. So 3,000 into 12%, how much? 360. So balance is rupees 2,640. This is the price. And the next step is less import related expense. So suppose if these goods while imported from AE2 Limited, if they would have been given in the question, say customs duty of rupees 300 incurred per unit, and freight of rupees 100 paid. So if similar type of items were given, that will not be reduced, but nothing has been given. And after that, compare these two prices. If there is any difference between unrelated party import and related party import, that will be adjusted. So nothing has been there. So this is the arm's length price to 2,640. And this rupees 2,640 is the arm's length price which should be paid for import. Remember, it is P&L account debit side. Even though we are starting 3,000, which is a resale price in India, what we are trying to find out is the arm's length price at which it should be imported from related party. So arm's length price is 2,640, arm's length purchase price or import price. But actually at what price we are importing it? So we are importing it for rupees 2,900 per unit. This is a TP. So something is different here, because arm's length prices you can pay rupees 2,640, but what we are paying is rupees 2,900. Remember, it is P&L account debit side. Payment of expenditure exceeding the arm's length price. So arm's length price 2,640, arm's length payment, but the actual transfer price payment 2,900. So excess payment is rupees 260 per unit. So how much unit has been imported? 100. So 260 into 100 is the income to be added back to the net profit. This is resale price method. Resale price method is, compared to other methods, it's a little bit easy. So they never asked the resale price method for exam. Actually, before 2021, not 21, during that COVID period, right? We can say up to 2019. They are asked the questions only from this first method, comparable uncontrolled price method frequently. And only once in 2016, I think, for all the syllabus, they asked their question from the next method, cost plus profit method. But after that, from 2021 later, 2022, 23, 24, in between, they asked the questions from cost plus profit method, even transactional net margin method also they asked. So they never touched two methods. One is resale price method and another one is profit split method. So they never asked. That means it is a possibility also. Next time they may ask a new method of, for the first time they may ask a question from resale price method, or they may ask a question from profit split method. Okay, so now we can move to the third method. So the third method is cost plus profit method. It is best suited for manufacturing industries, this cost plus profit method. Manufacturing, not only the goods, even service is providing from India to outside India, or goods is manufactured here and exported to associate enterprise. In those cases also this method is suited. So under cost plus method, this is completely different from the other two methods, because other two methods are basically comparisons with the prices. But here it is not like that. Here the arm's length price is find out based on the profit margin. If it is cost plus method, we are taking the gross profit margin as a benchmark. But under the next method, transaction net margin method, we will consider the net profit. So the idea behind this method is, the manipulation is happening at the time of loading profit and fixing price. There is no manipulation in actual cost of production or actual cost of providing a service to AE, because our cost of production and the books and everything is audited. So for cost details, we cannot make any manipulation. When we are making manipulation, or we are trying to manipulate the price so that the profit can be reduced. So based on this, they are saying actual cost nobody can be manipulated because it's audited and books and documents evidence is available. So that should not be touched. But we should think about the profit margin, because in that people are usually making the manipulation. So first step, to the associated enterprise for providing services or manufacturing goods and exporting, what are the actual costs incurred for production or for providing service? For example, there is a company in Chennai which is developing a software and exporting to US to its associated enterprise. So for providing that service, actual cost of providing that service, there is actual expense incurred, cost incurred in India is 10 lakhs. But they are billing at rupees 12 lakhs. So our question is whether this 12 lakhs is arm's length. That's our question. So this method says, So you simply ignore the profit loaded by the Indian entity, just to take the actual cost of providing that service or actual cost of production in case of goods, 10 lakhs. So take that. And then for a similar type of services or a similar type of goods we manufactured and exported to unrelated parties in US, in that transaction, what is our normal gross profit margin? Remember, margin means is in percentage. Gross profit margin can be found out basically in two models. So number one, either as a percentage of cost or as a percentage of sales. In examination, they asked both types. Gross profit margin as a percentage of total cost or gross profit margin as a percentage of sales. Both they asked. So you should be careful. So in two ways we can represent gross profit margin, either as a percentage of cost or as a percentage of sales. As a percentage of cost means gross profit divided by cost into 100. As a percentage of sales means gross profit divided by sales into 100. So anyway, we have to take the comparable gross profit margin with the unrelated party. Gross profit margin, remember, percentage. But this gross profit margin compared to the actual gross profit margin earned with the related party transaction, both should be at the same comparable level. So if there is any difference in item which would affect the cost profit margin, gross profit margin, then that should be adjusted. So after adjusting the normal gross profit margin with unrelated party, take the adjusted gross profit margin. And this adjusted gross profit margin should be added to actual cost. Earlier example, 10 lakhs. Actual cost of providing the services or manufacturing goods to AE. On that, we should add the adjusted GP margin, or we can say adjusted arm's length gross profit margin. So this arm's length gross profit margin in percentage should be added to the actual cost of providing goods or services to the associated enterprise, related party. We will get arm's length sales. And this arm's length sales should be compared with the real sales we billed the associated enterprise. If there is any difference, we can make the variation. And usually cost plus profit method and even transaction net margin method is best suited for export. It is applicable for credit side of the P&L. So actual billed should be compared with the arm's length amount to be billed. Difference we have to vary. So this is a theory. So direct and indirect cost incurred by assessee for goods or services produced or provided to AE should be taken from our books. Actual data, actual cost. See, we have actual cost and we have actual sales also. Actual sales is tainted, manipulated. So we have to take the actual cost with AE and then add adjusted GP margin. Adjusted GP margin means normal gross profit markup in comparable uncontrolled transaction in percentage. Adjust such a margin for material difference. Here also we can say related party is with the related party we are providing warranty. Unrelated party we are not providing warranty. So definitely it will affect the profit margin. So similar type of items we should compare with both margin. Sometimes we have to add, sometimes we have to reduce some items. So depends on. By reading the question, we have to judge that whether it should be added or less. So adjust such a margin for material difference. So we will get the adjusted gross profit margin. And this adjusted gross profit margin that should also be related to production, because direct and indirect costs related to production only should be taken. Administrative expense and indirect cost not related to production should not be considered in cost. And similarly, such a type of material difference which will affect only the net profit, which will not affect the gross profit, should not be considered. So direct trading account debit or credit, which will affect the GP margin. P&L account debit or credit will not affect the GP margin, because GP margin means the direct cost, what is the gross profit on that work. So that we are finding out, not the administrative and other indirect expense we will not be considered here. This adjusted GP margin should be added as profit to the actual cost. We will get the arm's length price or arm's length sales to be billed. So we will go to the question. Remember, there are two methods, either GP margin as a percentage of sales or GP margin as a percentage of cost. So how we will find out that? So if the question says that 35% on work or 35% on sales, then that means it is as a percentage of sales. So if they are saying 35% on cost, then that GP margin is represented as a percentage of cost. So on cost means cost is 100. On sales means sales is 100. So cost plus margin or sales plus margin. So some costing basic idea you should keep in mind. So the representation of margin as a percentage of cost or as a percentage of sales is very important. So now we can go to the question, the seventh question. So Nano Incorporation, a German company, holds 45% of equity in High-Tech Limited, an Indian company. So we can say Nano Incorporation and High-Tech Limited Indian company are AE, 45% equity. High-Tech Limited is engaged in development of software. High-Tech is Indian company. Indian company engaged in development of software and the maintenance of the same for customers across the globe. Its client includes Nano Incorporation. So AE is also a client. During the financial year 24-25, High-Tech Limited had spent 2,400 man hours for developing and maintaining software for Nano Incorporation, with each hour billed at rupees 1,300. Actually, this is the transfer price, actual sales with the AE. For this actual sales, we have to find out the ALP sales. This is actual billed. Next data. Cost incurred by High-Tech Limited for executing work for Nano Incorporation amounts to rupees 20 lakhs. So this is actually the actual cost of providing the services with the AE. This is our starting point of computation. 20 lakhs. 20 lakhs should be taken. Now, regarding the margin, they are saying an unrelated party transaction. High-Tech Limited had also undertaken developing software for Modi Industries, for which High-Tech Limited had billed 2,700 per man hour. So that is a sales with the unrelated party. Sales with unrelated party. We don't need the sales with unrelated party. We need the margin. The persons working for Modi Industries and Nano Incorporation were part of the same team and were of matching credentials and caliber. High-Tech Limited made a gross profit of 60% on Modi Industries work. Yeah, that is the data we require. Normal GP margin with the unrelated party. See, 60% on Modi Industries work means whether it is 60% on sales or whether it is 60% on cost. If they say on work, no, on work means on sales, on billed amount. 60% on Modi Industries work. We will say there is a project is coming. On that project, this much profit. On this project, this much, that means sales. On work means on sales, not on cost. So 60% on Modi Industries work. So remember, this is 60% on sales. They are giving GP margin as a percentage of sales. High-Tech Limited's transaction with the Nano Incorporation are comparable to transactions with the Modi Industries subject to the following differences. So with the related and unrelated, they are giving the difference. Nano Incorporation gives technical know-how support to High-Tech Limited, which can be valued at 8% of the normal gross profit. That means the normal gross profit margin. Modi Industries does not provide any such support. Remember, this 8% you should not adjust directly, because the reason is they are saying 8% of the normal gross profit. That means 8% of margin. So here the margin is 60%. So 60% into 8%. That should be taken. That's very important. So on normal gross profit, if they are saying 8% on sales directly, then we can adjust. Directly adjust. But this they are saying 8% of the normal margin. That is the first material difference. And second one, since the work for Nano Incorporation involved a huge number of man hours, a quantitative discount of 14% of normal gross profit was given. That is also 14% of normal gross profit. So related party, for related party, they given a quantitative discount. And for related party provided technical know-how. That means for unrelated party, they are not providing technical know-how. If they are not providing technical know-how or support, we will provide a technical know-how and support for that work, so that we will build it to more. We will be build more, because we are incurring cost. So we will build it more. But for Nano, we will bill it less, because they are providing technical support. And second one, for unrelated party, the gross profit margin will be more. Why? Because we are not giving any discount. But for related party, we are giving discount. So the related party's margin will be less and unrelated party margin will be more. This is the second difference. And the third difference, High-Tech Limited had offered 90 days credit to Nano Incorporation. Okay, if we are giving credit to Nano Incorporation, related party, we will bill more because we are incurring expense. So the margin will be more. The cost of which is measured at 2% of the normal billing rate. Yeah, here it is very important. 2% of normal billing rate. Rate means price, selling price. Here we can adjust directly, not on margin. No such a credit was offered to Modi Industries. So remember, first thing is technical support. Related party providing technical support, unrelated party not providing us technical support. So for unrelated party, we are incurring more expense and we are billing more. So the gross profit margin with unrelated party will be more to that extent. And second one, we are giving quantity discount to related party. Since we are giving discount, the selling price will be less, automatically margin will be less. So gross profit margin is lower in second case. But unrelated party, we are not giving discount, the margin will be more. Third part, we are giving credit to related party, margin will be more. But for unrelated party, there is no credit, cash and carry. So the margin will be less. So first two items are on markup. But remember, second item is on sales, direct. Third item. So first item, value of technical know-how, 8% of 60%. Remember, 8% of 60%. Unrelated party is providing technical know-how, but related party is not providing technical know-how. We are taking the related party margin 60%. As the related party does not provide technical support, we have to arrange a technical support for which we will incur more so that we will bill more. So 60% is more margin. So we have to reduce it compared to make to the normal other level, related party level, we have to reduce. So 8% of 60%, because question itself says that 8% of gross profit margin is 60. So 8% of 60, 4.8, we have to reduce. Second one, quantity discount given to Nano Incorporation. Nano Incorporation's profit margin is lower because we given discount. So the selling price will be less. So profit will be less. So margin also will be less. But unrelated party, we are not giving discount. So the 60% margin with unrelated party is high. So to make at the same comparable level, reduce it. So 8.4%. That is we have to reduce. So balance 46.8%. Now to Nano Incorporation, we give a credit period so that its margin will be more. Unrelated party, we didn't give any credit, so margin is less. To make it the same level, add 2%. 2% of 100%. 100% means that is sales. So directly 2% we can add. Because the 60% is as a margin on sales. So this 2% is also on sales. So direct 2%. 48.8% is the arm's length margin to be billed as a percentage of sales. Because on work, on sales. So this 48.8% on sales is the arm's length margin to be billed. Okay. So now we can go to the straight away we can compute the arm's length price. Simple. This arm's length margin should be added on actual cost of providing goods or services with E. So that is given in the question 20 lakhs. So 20 lakhs is the cost. So we need 48.8% margin on sales. So that means sales is 100. So this 20 lakhs is sales minus margin. That is 48.8 is the margin. So therefore 51.2% is 20 lakhs. Because it is a percentage on sales, right? 48.8% on sales. So sales is 100, right? So to get the cost amount we know 20 lakhs. So sales minus profit margin 48.8. So 100 minus 48.8, 51.2 is the cost. Then what will be the 100 into 100? We will get the sales. So directly you can add the margin. So 20 lakhs divided by that is 48.8 into 51.2. We will get the profit margin 19 lakh. Sorry, 20 lakhs divided by this is 51.2. Then what is for 48.8? So we will get that figure 19 lakh 6,250 is the margin. Or if you put 100 directly, you will get the figure 39 lakh 6,250. So in both way we can do. So arm's length amount to be billed or arm's length sales or transfer price is 39 lakh 6,250. But actually what we build is in the given the question, that is per man hour we have billed 1,300 to Nano and actual hours incurred is 2,400 man hours. So 2,400 into rupees 1,300. What we build is 31 lakh 20,000. To be billed is 39 lakh 6,250. Remember, it is P&L account credit side. Sales is understated. So understated to the extent of 7 lakh 86,250 to be added. But if it was reverse, Arm's length was 3120 and actual build is 39,06,250. TP provisions will not be applicable. But here sales is less than the arm's length. So difference 786,250 should be added. So this is cost plus profit method. This is actually an exam question. They asked a very old exam, that is November 2016. The same question they taken and in another pattern they asked with the change in figures. The major change was 60% on cost. So in this question, the question says 60% on Modi Industries work. They asked another question, gross profit margin as a percentage of cost. If it is as a percentage of cost, the only difference is last moment when we take the cost, that cost should be taken as the 100. So here instead of taking this 51.2, we will take the another number 48.8. So like or directly we can add. If cost is 100 and margin given is as a percentage of cost, directly find out the arm's length margin. This 48.8% directly can be added on 20 lakhs. 20 lakhs into 48.8% margin. We will get the arm's length sales. That's the only difference. They are made a change when asking a question. Recently, I think 2022 or 23 like that. They asked for no syllabus a question. In that same pattern, even adjustments also same. The only difference is they uses the word 60%. I'm not sure whether it is 60 or something like that. On cost. Clearly say on total cost. So that question is based on margin as a percentage of cost, but this question margin as a percentage of sales. So this is cost plus profit method, best suited when Indian entity manufacturing goods or providing services and exported to related party outside India and build. So for arm's length the sales to be built, we have to apply, we can apply cost plus profit method. Next method, once we studied this method, next method is very easy. Transactional net margin method. So this is actually cost plus profit method. Here we are using normal GP margin. But in the next method, they will take net profit margin, net profit margin. Again, there also net profit margin as a percentage of sales they can take, net profit margin as a percentage of cost they can take, net profit margin as a percentage of asset employed they can take. So because net profit can be represented in different basis. So usually for exam purpose, you should keep in mind either on cost or either on sales. They will ask any one of these, but in practically a lot of other bases also we are using in TP. So transactional net margin method. Next method. So we will discuss the theory first. This is cost plus profit method. Third method. So next transactional net margin method. After that we will discuss profit split method. Simple. The only difference is instead of GP, you have to take NP, net profit margin. So first step is same. Total cost incurred. See here the word is direct and indirect cost. But when it is come to net profit, total cost, all direct costs, even all indirect costs, any indirect expense related to that goods or services exported to non-resident, which should be considered. Total cost incurred in international transaction with AE. Then add adjusted net profit margin. From where we will take the net profit margin. Similar, comparable uncontrolled transaction with unrelated party in uncontrolled condition. Similar comparable transaction. What is the net profit margin in that transaction? That should be taken. Add or less material differences which would affect the net profit margin. Adjusted net profit margin we will get. This adjusted net profit margin should be added to the actual total cost. We will get the arm's length, the sales to be billed. So there also cost plus profit method also same method, same way we are solving the question. The only difference is there we will consider GP margin and only direct and indirect cost will be taken. But here we will consider total cost and net profit margin will be taken. Rest of the things are same. There we will consider material differences which would affect the GP margin. Here we will consider the differences which will affect the net profit margin. Adjusted net profit margin will be added. We will get the arm's length price. So while we're solving question, the simple method is first read the question. Once you sure that it is TNMO method or question says that compute arm's length price under transaction net margin method or any indication like that, some net profit margin is given. Even though they are not mentioning TNMM, we can assume it is TNMO method. Once identify that, first step is go to the unrelated party. What is unrelated party's sales? What is the unrelated party's total cost? Reduce that. You will get unrelated party's profit. Then find out the margin. If you take the margin as a percentage of cost, here also it should be added as a percentage of cost. If you finding the margin as a percent of sales, here it should also be added as a profit margin as a percent of sales. If the question says consider net profit margin as on sales, then you should consider sales only. If the question says net profit margin as a percentage of cost, then we should take cost only. The question is silent, we can take any margin, either cost or either sales. So there is a question. I think the 9th question, right? 8th is actually profit split method that we will do next. So first 9, question number 9, Andes Incorporation. Yeah. So Andes Incorporation, having its business in Malaysia, has advanced a loan of Malaysian dollar 1,60,000 to Andes in Limited India. Book value of total assets. Remember, in all other questions, from the first sentence itself, we can identify whether they are AE. But here they are simply saying Andes Incorporation, having its business in Malaysia, advanced a loan of 1,60,000 to Andes Limited India. So we have to check from the data given whether they are AE. So 1,60,000 Malaysian dollar to Andes Limited. Book value of total assets of Andes Limited was 125 lakhs. That is in rupees. That should be keep in mind. The loan is given in Malaysian dollar, but this book value of asset is given in 125 lakhs rupees. Andes Limited provides software. Yeah, all other details are related to transfer price. So from this, we have to find out AE, whether they are AE. So one entity gives loan to the another entity. For the borrower entity, the loan amount should constitute at least 51% of the book value of assets of the borrower enterprise. So here 1,60,000 Malaysian dollars into exchange rate is given in the question. 1 Malaysian dollar is 45. So into 45, rupees 45. So we will convert that into Indian rupee. How much? 57.6? 70? 72 lakhs, right? 72 lakhs. So this rupees 72 lakhs divided by rupees 125 lakhs into 100. What's the percentage? 57 point. Yeah. So it is more than, the loan amount represents more than 51% of book value of assets of the Andes Limited. So they are AE. So this first we should establish they are AE. Then we have to write separately. It's an adjustment. Because question nothing says regarding shareholding. Question doesn't say holding subsidiary. So only if they are AE, transfer pricing provisions are applicable. So how they are AE? Because of this condition. Advancing loan which constitute at least 51% of book value of assets for borrower. Okay, they are AE. Now we can think about the TP. Andes Limited provides, that is Indian company provides, software backup support to Andes Incorporation. Again, export. P&L account credit side. Andes Limited has spent 50,000 man hours during the financial year 24-25 for the services rendered to Andes Incorporation. The total cost for Andes Limited is MD Malaysian dollar 75 per man hour. So this is the actual cost. We need this actual cost. This is TP, actual build. Andes Limited has billed Andes Incorporation to Malaysian dollar 90.75 per man hour. Gamma Limited. Here comes the unrelated party. Gamma Limited in India, which has a similar business model, provides software backup support to Olive Incorporation in Penang, Malaysia. Gamma Limited's cost and operating profit are as here under. So direct cost 600, indirect cost 200, operating profit is 200. Calculate arm's length price for the transaction between Andes Limited and Andes Incorporation based on the above data of Gamma Limited using transaction net margin method. Assume 1 Malaysian dollar is equal to rupees 45. Explain if there is any adjustment to be made to the total income of Andes Limited. Malaysian dollar. Okay. Now we can go to the question is over, right? Question is over. Yeah. So first take the unrelated party. Unrelated party, this is here it is with Gamma unrelated party. What is the total cost? Total cost is 600, 200, 800 rupees in lakhs. 800 lakhs. So what is operating profit? That is 200 lakhs. So we can take as a percentage of cost. If you are taking as a percentage of cost, the net profit margin is 200 lakhs divided by 800 lakhs into 100. So what is the net NP, net profit margin? What is net profit margin? 25 around percent, right? 25%. From the question, there is no material difference. Nothing is mentioned. So no material difference means no adjustments. This 25% is adjusted NP margin. Simply take this net profit margin with the actual cost. We will get the arm's length sales. It's actually an exam question, right? So find out the actual cost. The actual cost, Andus, this Indian company Andus Limited, is 75 per man hour is the cost. What is the total time spent? 50,000 man hour. So what is the cost? So the cost is 50,000 Malaysian dollar. 50,000 man hours into 75 Malaysian dollars into rupees 45. We will get the cost in INR. What's the total cost in INR? Rupees 16 lakh. 87 lakh. 50,000. 16, 87, 50,000, correct? This is the actual cost. From the question we can identify. They incurred 50,000 man hours for this work. And the actual cost incurred for Andus Limited is given in, not in Indian rupee, given in Malaysian dollar. 75 per man hour. So 50,000 man hours into 75 Malaysian dollar per man hour, converted into INR into rupees 45. 16 lakh 87,000. 16 lakh 80. So 16 crore 87 lakh 50,000. Yeah. Now add the NB margin. Okay. We take the NB margin as a percent of cost or sales. This 25% is as a percentage on cost or sales. Cost. So this is a cost. So directly add margin. 25% of 16 crore 87 lakh 50,000. So add margin. 25% margin on cost. We will get arm's length sales. Margin or arm's length sales? Margin. Arm's length sales 21 crore 9 lakh 37 500. So what is the margin? Just to write here margin. Just the margin 4 lakhs. 4 crore 21 lakhs 87 500. So arm's length sales to be billed is 21 crore 9 lakh 37 500. Okay. And what is the actual they build? Actual they build is 90.75 per man hour. This is the TP. So TP here. So TP we have to find out. So 50,000 man hours into 90.75 into rupees 45 is the TP sales. TP sales. That is how much? 20 crore 41 lakh 87 5. So the sales is underbilled. Actual to be billed is 21 lakh 9,000 21 crore 9 lakh 37 500. But the transfer price sales is 20 crore 41 lakh 87,500. So what is the variation to be done to the net profit? 67 lakh 50,000 to be added. So this is TNM method, transaction net margin method. So last 3 years, 2 times they asked questions from this TNM method. So the latest the trend is either cost plus profit method or TNM method or CUP method, first method, comparable uncontrolled price method. Other 2 methods never asked. So now next step one is profit split method, that is the last method. Practical application also very rare. Examination they never asked, but in detail in study material they are explaining the concepts of profit split method. So as their detailed discussion is there, it's a warning, it's a possibility they may ask the profit split method question. So I will explain how it will be computed. So this profit split method is applicable only when multiple associated enterprise located in different countries are coming together to provide a big work. So in that case, this method is suitable. So there is not 1, 2 AE, maybe 3 or 4 or 5 AE, and all of these AEs are contributing for a common work and they are billing their share. So the question is whether the share they billed are adequate, whether it is at arm's length. because entity located in India is giving technical support, entity located in Singapore is providing production, and German entity is supervising. So they are billing all these three together as a work. So each country's AE will get their share for the work they are done. So the question is whether the amount billed by each entity in the country is arm's length, especially with the Indian entity. So multiple international transactions which are so interconnected that they cannot be evaluated separately. In that situation, we have to apply this profit split method. So in this combined transaction with multiple AEs are involved, first step is identify the total profit earned from this total work. See, for example, an international construction work is up. So Malaysian holding company got the work. It has a subsidiary in India and it also has a subsidiary in Germany. So German company provides the technical support. Indian entity gives the raw materials and procurement and production. And Singapore entity, the ultimate finalization and the billing. So in this case, all these three entities together, what is the total profit they are earned from that work? Combined net profit must be identified. Then this combined net profit should be divided among all these associated enterprise based on their basic return, like see what functions they are performing, what are the assets they are employed for this work, what are the risks they are assumed. That is known as FAR analysis. Functions performed, assets employed, risk assumed. So based on this FAR, there will be some allocation ratio for the profit between this entity. So Indian entity 30%, German entity 40%, and again 30% for the Singapore entity. So that is 30, 40, 30. So that will be given in the question. We need not worry about FAR ratio. That will be given in the question. So based on that FAR ratio, this profit should be divided. Which profit? Combined net profit. That means what is the top final amount billed for the client? Reduce all the cost incurred by Singapore entity, Indian entity, German entity. We will get the combined net profit. So this combined net profit should be divided among these three entities based on FAR ratio. So we will get the share of profit. And this share of profit should be added to actual expenditure or actual cost incurred by each entity separately. So Indian entity incurred for this particular work, raw material production and procurement, they incurred total 1 crore rupees. Their combined net profit is based on FAR ratio 30 lakhs. So 1 crore plus 30 lakhs. 130 lakhs is the amount they have to bill. This is arm's length sales. But actual billed may be 120 or actual billed may be 140. Then we will discuss. Depends upon that. We will compare. Depends upon that. We will find out whether there is any variation in profit to be added. So first step, identify the combined net profit. And then that combined net profit should be divided based on FAR ratio. And there are two methods, that is profit split method. That is, one is total profit split method and second one is residuary profit split method. If it is a residuary profit split method, the profit will be split in two steps. First step, based on a basic return. Basic return means, so if Indian entity is incurring this type of expenditure in another work, minimum they will get this much return. So usually basic return is calculated as a percentage of cost incurred. So if this much cost we are incurring for some other unrelated party, we will earn at least 20% profit on the cost incurred. So that is known as basic return. FAR ratio is different. FAR ratio means based on functions performed, assets employed and risk assumed in that international work, what is a return, fair return they have to receive. That is FAR ratio. Basic return means that is a usual very basic return. At least we should get this much. FAR ratio will be definitely more than the basic return. So if basic return and FAR ratio is also given, then first the combined net profit should be allocated to all the three entities based on basic return. And remaining profit, if any, that should be divided among the FAR ratio. So if two-step division is there, that is known as residual or residuary profit split method. If no basic return, only FAR ratio is given, simply divide the combined net profit based on FAR ratio and add it to actual cost. We will get the arm's length price. That is known as total profit split method. So they can ask a problem in two methods, either total profit split method or residuary profit split method. If the question is silent, we have to do only the total profit split method. If they are given basic return and FAR ratio and asking us to compute the profit split method, then we have to do both. Sir, whether the arm's length price in both method will be same? No, definitely will be different, because profit is allocated in two ratios. So definitely the final sales will be different. So this is the way we are finding out the profit split method. So we are actually calculating the arm's length price of the Indian entity only, but for finding out the total profit, we need the other entities total cost also we require, because then only we can find out the total cost. Once we got the total cost this for the international work, then only we will get the combined net profit. Okay, so we will solve a question so that you will get a better idea. I will solve both methods. Okay, so first one, AE1 Limited, Indian company, the related party is very clear, that is AE2 Limited, foreign company, 30%, AE3 Limited, foreign company, 30%, that is also AE. There are two AE, AE2 Limited, AE3 Limited, financial institutions, Indian company. Yeah, AE1 Limited is an investment advisory company which is in association with AE2 Limited, assists its clients with the foreign acquisitions. AE3 Limited, which is based in USA, has worldwide presence. AE1 Limited is approached by M for identifying potential target companies for acquisition in the USA. So actually they are providing some services, acquisition, mergers and acquisition services. In order to serve M, AE1 Limited and AE3 Limited have each contributed integrally to identification of potential targets and assisting M with the acquisition process. So for the above, AE1 Limited received consideration of $50,000. Then the financials are as below. AE1 Limited and AE3 Limited. What is the revenue they got? Total revenue is $50,000. That $50,000 is split among AE1 and AE3, $30,000 and $20,000. Next data, very important. We need that. Cost. AE1 Limited incurred $20,000. AE3 Limited incurred $8,000. Profit, AE1 $10,000, AE3 Limited $12,000. That will be the profit they will show in the books, but that we won't accept. The arm's length sales is 30,000 and 20,000 is the arm's length sales. Transfer price sales. We have to find out the arm's length equivalent to that AE1 Limited revenue 30,000, whether it is at arm's length, that we have to check. So AE3 Limited no need to check, because AE3 Limited is not located in India. We have to find out the arm's length price of the entity located in India only. Factors to be considered. They are giving all the data. Basic return is given, that is for profit split method. So basic return they are given in the B point, right? That is for AE1 Limited and AE3 Limited, that is $800 and $3,000. $3,000 for AE1, $800 for the AE2 Limited. At least they should get that much basic return. See how they calculated basic return, that is given in the first paragraph, right? The normal basic return is ordinarily calculated as a percentage of cost incurred or gross revenue or capital employed. In this example, it is assumed as a percentage of the cost. Based on the FAR analysis, basic return of AE1 and AE3 are determined to be 15% and 10% respectively. See, we will get that figure, 15% and 10%. 15% of cost, right? 20,000 into 15%, how much? 20,000 cost incurred into 15%. 3,000, right? And 8,000 cost incurred into 10%, how much? 800, right? So that is the way how the 3,000 and 800 they arrived. It's given. If they incur cost, at least they should get 15% and 10% of the cost as a basic return. So that is 3,800. Total 3,800. And now on the basis of FAR ratio, 70%, 30%, 70% for AE1 and 30% for AE3. Apply total profit split method and residual profit split method. So first we should identify the total profit, combined net profit. So total amount they billed is for the client is 50,000. $50,000. What is the total cost incurred by both entity? 20,000 plus 8,000, 28,000. So combined net profit. What is the combined net profit? $12,000. Correct? 12,000, right? Or 22? So sorry, 22. 22. Sorry, 22. $22,000. Now, once we got the combined net profit of 22,000, then the next step we have to identify is the split. So this combined net profit, first I am doing the total profit split method. So based on the FAR ratio, 70 and 30. So 70% for AE1 and 30% for AE2. This is for AE1 and this is for AE1 and AE3, right? Yeah. How much? 22,000 into 70%. 5,400. And here balance 6,000. Actually, the 6,600 we don't require that because that is belongs to the other entity. Other entities country we don't know how they find out the ALP. We need Indian entity only AE1 15,400. So now take the cost incurred by AE1 Limited Indian entity for this work, that is $20,000. Add this profit we arrived. So based on FAR ratio, the return they should get $15,400. So what is the amount they have to bill? $35,400 they have to bill to be billed. Or we can say ALP sales. What is the actual bill? Actual bill is 30,000, right? 30,000. So income to be varied is $5,400 to be added to the net profit of AE1 Limited. If we apply total profit split method. This is total profit split method. Now we can go to the residual profit split method. Okay, in case of residual profit split method, first we should identify the combined net profit, same 22,000, which we arrived. Then it should be divided, not fully, up to the basic return. They should apportion the profit. Basic return for AE1 Limited is $3,000. That is 10% of their 15% of their cost, and for other entities $800. And then out of 22,000, if you reduce 3,800, what is the balance? This minus 3,800. What is the balance? 18,200. This 18,200 is the residual profit. After reducing the basic return to each entity, AE1 and AE3, the remaining profit available for distribution 18,200. That should be again splitted based on FAR ratio 70/30. So 18,200 into 70%, 12,740, right? And here that's actually not required. 12,740, that's enough. So this plus this added to cost. So cost given $20,000 and basic return profit 3,000. FAR profit to be received 12,740. Therefore, arm's length price to be billed how much? 35,740. But actual to be billed, actual billed is 30,000. So income to be varied is 5,740. So actually profit split method is very simple. If they are asking for exam, it's very simple. Out of all these methods, this method is the most simple method. So find out the combined net profit, split either FAR ratio, or if they are giving basic return ratio and FAR ratio, then first up to the amount of basic return, distribute the amount of profit based on that basic return amount. That will not be a ratio, that will be an amount we have to find out. In this question, there is straight away given. For exam purpose, sometimes they will say basic return is 15% of cost and 10% of cost. They won't give the figure 3,800 for exam purpose. This is actually this to explain the concept of this method. I use the detailed question. In your examination, sometimes they won't say this 3,800. Instead of that, they will say basic return is 15% of cost and 10% of cost. Then they will say FAR ratio is 70 and 30. So we have to find out that 3,800. So this is the profit split method. So profit split method is over. So comparable uncontrolled price method. And second one is that is resale price method, and then cost plus profit method, then transactional net margin method, and then profit split method. So these are the 5 methods. So sometimes an assessee may have multiple arm's length price in one method. So which method is most suited? It is the responsibility of the associate to find out the most appropriate method. So based on that is not most selection of most appropriate method. So based on nature and class of international transaction, class of associate enterprise and FAR ratio used by them, and availability, coverage and reliability of data, degree of comparability, to what extent we can make the comparability, what is the availability of data. So based on these guidelines, assessee has to select which method is most suited for the international transaction for finding the ALP. They have to select. So if assessee selected one method, so he got say TNMM method or cost profit method. Okay, in that again there is another issue. Under cost profit method, there are a lot of comparables. So comparable uncontrolled transaction, there is not only one transaction, there are 2, 3, 4, 5, 6, lot of comparable uncontrolled transaction. Then what we will do? So if there are multiple comparable transaction, we have to find out the multiple ALP. If we got multiple ALP, then we have to go to the arithmetic mean of that ALP and take the arithmetic mean as the arm's length, final arm's length price. If under a single method, multiple arm's length price is available, we have to take the arithmetic mean. But if the number of arm's length price is 6 or more, so if it is 6 or more, arm's length price are available, arithmetic mean is not possible. In that case, we have to go for the range concept. So if the number of comparables are less than or equal to 5, that is number of arm's length price are less than or equal to 5, then we can take the arithmetic mean. That arithmetic mean should be taken as the arm's length price. When we are taking arithmetic mean of the 5 or less arm's length prices, in that situation, they are giving a tolerance band, they are giving a convenience. The convenience is, suppose your arm's length price and arithmetic mean ALP, both are different. So what is the difference? What is the variation? If the variation is not exceeding 3% of the transfer price of the assessee, then it will be accepted. Your transfer price will be accepted. Arm's length will not be taken. So the condition is, if where the arithmetic mean is taken as the ALP, when we are taking arithmetic mean as the ALP, that is the number of ALP is less than or equal to 5. Especially first 3 methods, CUP, RPM, CPM and TNMM method. Okay. For profit split method and other method prescribed CBDT, anyway, even though less than 6 or more than 6, we will take only arithmetic mean. But comparable uncontrolled price method, resale price method, cost plus profit method, TNMM method, if the number of arm's length price got under a single method is 5 or less, we can take arithmetic mean of that all those arm's length prices, and that will be taken as ALP. But if the difference between such arithmetic mean ALP and actual transfer price is more than 3%, then only we have to proceed with the TP variation adjustment. But if the variation between actual transfer price and arithmetic mean ALP does not exceed 3% of the transfer price, then your transfer price will be accepted. That means there is no need for these arm's length price. And if the comparables is more than 6, equal to or more than 6, then we have to go for a table. We have to put a table. That is known as a range concept. In that table, a small arm's length price first, a little big figure next, that is ascending order. Arithmetic arm's length price should be, we have to arrange it in a table, and in that table we have to find out the 35th percentile and 65th percentile. And if the transfer price is in between 65th percentile and 35th percentile, in between that range, transfer price will be accepted. And if the transfer price is not between 35th and 65th percentile of the data set, then we should take the median of the data set, and that median of the data set should be taken as the arm's length price. This is known as a range concept. Usually they are not going to ask the questions on range concept in deep, but just you should understand this. So what is range concept? That is when the number of arm's length price under a most appropriate method is 6 or more, we have to find out the data set, and we have to put all these items in ascending order, and we have to rank them, and in ascending order put a data set, pure statistics. Then find out the 35th percentile and 65th percentile. If the transfer price falls between this range, TP will be accepted. If it is not within this range, go and find out the median of the data set, and corresponding to that median, what is the value that should be taken as the arm's length price. So this is the range concept. So just I am leaving this because we have limited time. and usually they are not asking in depth from this. But this 3% you should be keep in mind. They may ask a multiple choice question. And this range concept also they may ask. This percentile and all those things. Okay. And when we are applying range concept in comparable uncontrolled price method, only current year data must be used. But in resale price method, CPM and TNM method, total 3 years data must be taken. Current year and preceding 2 years weighted average data must be taken. After taking weighted average, put the data set ascending order, then find out 35th percentile, 65th percentile as usual. So examination, they never tested questions from this area. By seeing this, we will feel that it is complicated. Actually, it is very simple. That is why examination they are not asking. Practically also, everything is done by software. It is very easy. Now, this 3% tolerance band, when this is given, see, in a most appropriate method, assessee find out arm's length price, but he is getting more than one arm's length price. So if the arm's length price is 5 or less, then we will take the arithmetic mean. So in that case, the difference between ALP determined by using the arithmetic mean and transfer price exceeds 3%, then only we will proceed. So if it does not, the difference does not exceed 3% of the TP will be accepted. This tolerance band is not available in one situation. Only one situation this tolerance will not be given. That is, if the Indian entity carrying out a transaction with a resident of NJA. NJA earlier we just discussed. What is NJA? Notified Jurisdictional Area, Section 94A. Certain blacklisted countries with which India has no proper information exchange mechanism, where people dump their black money. So, notified jurisdictional area, there is a assessee in NJA, and that person carrying on a transaction with Indian entity, these two persons will be deemed to be AE, even though there is no 26% holding, even though there is no 10% guarantee, even though there is no 90% raw material procurement, even though any one of the transactions are not satisfied, but still Indian entity and the person located in NJA will be deemed to be an AE, and all the transactions in between them will be deemed to be an international transaction, and every transfer pricing provisions will apply except these three. The only advantage available under TP is this 3% tolerance band. That advantage is not available for international transactions carried out with persons located in NJA. That is prescribed in 94A. In all other cases, under transfer pricing, we will get this 3% tolerance band. And next area we have to give it that's the power of AO and TPO, all those things we discussed. So next area, most important area is that is secondary adjustment. Secondary adjustment means when you are making this transfer pricing adjustment, and or transfer pricing adjustment can be happened in many other way also. That is how we will rotate this. How we will rotate this? No idea. So first that I will do. First I will explain what is secondary adjustment. Secondary adjustment means due to the primary adjustment. If there is a primary adjustment happens to an assessee, then only there will be secondary adjustment. So what is primary adjustment? Primary adjustment means a person's income has been varied due to the adjustment of the transfer pricing officer. That is ALP determined by transfer pricing officer or by the assessing officer based on report of the TPO, and income is increased. Number two, a person's income is increased due to he declared for safe harbor rule. So if he opted for safe harbor rule, to comply with the safe harbor, minimum percentage notified under safe harbor rule he has to declare. So by declaring that safe harbor, his profit is increased. So in that situation, primary adjustment happens. Number three, sometimes there may be some dispute relating to transfer pricing adjustment, and assessee may go for double taxation relief through MAP, mutual agreement procedure. He can file a complaint with the concerned income tax department in the other country and here in the income tax department. That is mutual agreement procedure. So by considering that application, if the income tax department itself or the government itself give a solution to him, that is known as MAP solution. So based on MAP procedure, if there is an income variation happens, that is also a primary adjustment. Or assessee itself himself is suo motu making adjustment to transfer price in his return based on the arm's length price declared by the assessee itself. So these are the reasons where primary adjustment can be happen. So whenever there is a primary adjustment and that primary adjustment amount is more than the limit, that much amount must be put back to India. That is the condition put under the income tax law. That amount should be brought back to India or repatriated back to India. Primary adjustment, how primary adjustments happen? Number one, transfer pricing adjustment, income is increased and that income is increased suo motu by assessee. Assessee itself is declaring this is my ALP, actually this is my transfer pricing, I am making the increase. Okay, suo motu by assessee in his return of income. Or sometimes based on transfer pricing adjustment made by assessing officer and it is accepted by assessee, he does not have any dispute. And third one, due to advance pricing agreement, that APA, assessee entered into an advance pricing agreement with the department. Based on that APA pricing methodology, his income is increased and his income return has been increased. Or due to safe harbor rule, or due to MAPS resolution, that is a mutual agreement procedure. See, due to transfer pricing, there will be a double taxation because Indian entities' income is increased. Correspondingly, the foreign entities' income has not been reduced to that. So that income will be taxed in that country for AE and Indian entities also added and taxed here. So for the same income for two persons, two different countries, it is taxed. Because in transfer pricing, definitely there will be double taxation. Because here in Indian entity, income is varied. Correspondingly, that non-residence income is not reducing. So what happened? There will be double taxation. But not for single assessee for two countries. Two different assessees, two different countries for the same income taxed twice. This is known as economic double taxation. So if single person for the same income taxed in two countries, jurisdictional double taxation. For jurisdictional double taxation, we have solution. DT agreement, 91 relief, unilateral, bilateral relief available. But for economic double taxation, direct relief is not available. So what we will do? So for economic double taxation, relief can be obtained only through MAP. With that country, associate enterprise country and India, there should be a double taxation avoidance agreement. As per there is the double taxation avoidance agreement, there should be a specific clause that for associate enterprise and transfer pricing related issues and they can go for MAP resolution. There should be a specific provision in the DT agreement. Then we can go for economic double taxation solution under MAP. So if the concerned government and the Indian entity decided and they can give a relief, then relief will be available. But there is no assurance. Sometimes relief will be available, sometimes not. So that is known as mutual agreement procedure. Or otherwise we can say that whenever there is a dispute in double taxation avoidance agreement, they can approach the concerned government who signed the DT agreement directly. That is known as MAP, high level resolution. So mutual agreement procedure resolved and assessee income or MAP resolution final decision was assessee failed department 1, then income will be increased. Or safe harbor rule or advance pricing agreement or suo motu made by assessee accepted by made by AO accepted by assessee and suo motu by assessee in his return of income or based on TP adjustment. So in that case, primary adjustment happened, that is income is increased. So if the amount of primary adjustment made by assessee or department is more than rupees 1 crore, then secondary adjustment is compulsory. So even though there is a transfer pricing adjustment, variation in income, but that amount does not exceed 1 crore, this section 92C secondary adjustment is not applicable. Okay, then what is secondary adjustment? Secondary adjustment says, so if there is a primary adjustment, that income is added to your net profit and you are paying tax here, but that much economic resources is not coming back to India. So whatever profit you diverted from India to that foreign country, that should be repatriated back to India in real money. So that AE should give back that money to India. It should be come to India. So that's the idea. So practically very difficult. So when it should be repatriated to India, they are saying within the specified date. Specified date is usually generally the specified date means a due date for filing ITR plus 90 days. So due date for filing ITR in respect of international transaction assessees will be 30th November. So 30th November plus 90 days is usually the time limit for repatriate that money within India. So within that time period, that is due date for filing ITR plus 90 days, if the money has not been repatriated into India, then what? Okay, then there will be deemed interest. because this much money which did not brought back to India will be treated as a loan given by Indian entity to AE, and on which notional interest will be calculated, and that notional interest will be taxable as income for the Indian entity, and you have to pay tax on that. So generally the time limit is 90 days from the due date for filing ITR. So if the money has not been repatriated within that time limit, then they are saying it will be treated as a deemed loan and interest rate will be applied. So interest will be calculated from the specified date. So, and how the interest will be calculated? So they are saying, if the international transaction is denominated in Indian rupee or whether it is denominated in foreign currency. If it is denominated in Indian rupee for the relevant previous year, for which year you are calculating the interest, for that relevant previous year, what is the SBI lending rate of marginal fund? What is the cost of lending rate for SBI? So that plus 3.25% should be applied. So if the SBI lending rate is 9, then 9 plus 3.25, for example, 12.25 will be the rate. So if the international transaction denominated at Indian rupee, then we should take SBI lending rate as on the 1st April of the relevant previous year. Remember, relevant previous year means for which year we are calculating the interest, that previous year. So that previous year's 1st April, what is the 1 year marginal cost of SBI lending plus 3.25. But if it is in foreign currency, we have to take 6-month LIBOR. LIBOR is actually outdated, but still they are using that word. 6-month LIBOR, London Interbank Offer Rate, on 30th September of relevant previous year plus 3%. So this interest to be calculated from the specified date. And that interest will be added to the income of the assessee. Income of the assessee. So if primary adjusted amount is not remitted to India within 90 days from specified date, deemed loan by assessee to NR assessee, interest on deemed loan at a notified rate shall be added. So what is the due date? Specified date. Specified date is usually 90 days from specified date. So specified date means normally due date for filing ITR, that is November 30th, because in all these cases definitely there will be November 30th because they are carrying out international transaction. Form number 3 CB has to be uploaded, so 30th November plus 90 days is the time. If money has not repatriated from 90 days from the specified date, remember interest is calculated from specified date. Interest is not calculated from 91st day. 90 days is the time cushion given to repatriate the money. So if you did not repatriate that money within 90 days, they are calculating interest from the early date, from the specified date, not from 91st day. If transfer pricing adjustment Sumoto made by the assessee, due date is the specified date plus 90 days, time limit for repatriation. If AO made in his order, assessment order, and assessee accepted, date of order by AO plus 90 days. And if advance pricing agreement is entered before the due date for filing ITR, then due date for filing ITR. But if the advance pricing agreement is entered after the due date for filing ITR for that relevant year, then end of the month in which advance pricing agreement is entered. And if safe harbor rule, due date for return of income, MAP resolution, date of giving effect by AO. So generally due date for filing ITR should be taken. If it is made by AO, order of the AO plus 90 days time for repatriation. But if not repatriated, interest is calculated from this date, not from 91st day. From 30th November, 1st December onwards, interest will be calculated. If it is not repatriated within 90 days. That's very important because in MCQ, while calculating interest, we will make the mistake. From specified date, it will be calculated. And sir, up to what time this will be calculated? So till the date when you repatriate that money, it will be continued. So for next year also, next year also, next year also, it will continue. So to make an end to this industry demanded, we need some other provision because majority of the companies are not going to repatriate that money because it is crores of rupees. They won't brought back that money into India. So government says another issue, that is you can do one thing. If you does not want to repatriate that money and if you does not want to make this additional national income based on interest, then do one thing. Pay some additional tax on that primary adjusted amount. Then you will be relieved from all the consequences. So option to pay additional tax at the rate of 18% income tax, 12% surcharge, mandatory. Normally surcharge is applicable only when total income exceeds 1 crore. But here mandatory surcharge 18% plus 12% plus 4%. So the effective rate will be 20.964%. This percentage should be applied on the money which you are not repatriating. That is primary adjusted amount. Sometimes some companies will say we repatriated this much. Okay, then remember balance amount. So balance amount they will apply 20.964%. Tax can be paid. This will be treated as a final payment and no further tax treatment. That means further there will be no notional interest calculation. After 3 years, current year 24-25, assessment year 25-26, there was a primary adjustment exceeding 1 crore. You didn't brought back the money till 2028. So in 2028, you want to pay additional tax. Remember, if you are paying additional tax on 2028, September 30, up to September 30, 2028, you have to pay interest. This interest income you have to declare. On 28th September, you can pay additional tax of 20.964% on the excess money which has not been repatriated and pay the tax. And this tax, if you debit it to P&L, it will disallow. It is not allowed as an expense. This tax is not an expense because this is equal to income tax. Income tax is not allowed as an expense while computing BG because company will pay this tax and they will debit such a tax payment and the P&L debit balance, right? Debit said they will debit in 2028 when they are paying the tax. Not allowed. This is not a business expenditure, not allowed. Because basically it is an income tax. So specifically section 40 subsection A subclause 2, income tax is not a business expenditure. It will be disallowed. So, but once you made this final payment, no further tax treatment, further no adjustment, nothing, you are free. To the extent of that primary adjustment, you are free. But next year again primary adjustment, again you have to repatriate. Otherwise notional loan, deemed interest will continue. So this is a portion of secondary adjustment. This is very important for your exam point of view. Yeah.
We are repatriating the money. We are not repatriating the money.
Yeah.
Paying additional tax, but after 2 years, then the interest amount should also be repatriated. The additional tax should be paid on the interest amount.
No. Additional tax is not applicable on interest. Additional tax is applicable only on the excess money. Excess money means the money we are made in primary adjustment. Interest amount you should be paid, but that interest also not allowed as expense. That interest is not we are paying, interest is income, right? Interest is calculated as income. On that income, you have to pay normal tax. This is additional tax to stop that calculation of deemed interest income. They are saying this excess money not repatriated is treated as a loan given by Indian entity to AE. So if it is a loan, interest is accrued. That accrued interest calculated at this rate, shown as income in the books of the assessee. If it is a company, they have to pay 30% or 25% tax. Got the idea? That is normal income. But this tax is to stop this treating as loan and the notional interest calculation. They are paying additional tax, you can pay and stop it. So you have only two solutions. Either you have to pay you have to declare notional income and pay tax, or you can stop this by paying additional tax, or you repatriate the money. But nobody is going to repatriate the money. Mainly the company will try to do basically this additional tax they will try to pay. Anyway, it is a loss because 20.964 is a big amount. But at least one time, if you yearly pay 20.964%, at least you can avoid that notional interest income, right? Otherwise, you could repatriate. Definitely, MNCs will find some other way. If they want to make some investments in India, they will route like this through route. They will show something like that. This money is repatriated, something like that. Anyway, they need to invest some money in here. And they will make some documents stating that this is the repatriation. And money came into the banking channel. They will definitely find a way. 100% sure. Already started. And now, next is 94A is another important area. We have to keep in mind in this area. This is also sometimes they are asking. That is 94A, notified jurisdictional area. So notified jurisdictional area, it's a small section, 94A. Actually, it is outside the TP provision, but it is related to TP. This is also an anti-avoidance measure. Transfer pricing is also a anti-avoidance measure. So 94A says a person in India should not make transactions with a person located in notified jurisdictional area. So far, no country has been notified. So far, no country has been notified. See, once notified Cyprus, within months, that notification withdrawn. Cyprus has been eliminated. Why? Because we're going to assume probably Cyprus government has been made an emergency meeting with the Indian authority and made pressure. Because if it is blacklisted, nobody will go and invest in Cyprus because of strict provisions. So, because of political reason, with retrospective effect, Cyprus has been withdrawn. That means now there is no country in this list, but this provision is keep it open as a warning. So, when a country is listed under 94A, that is a blacklisted country. Usually, blacklisted countries means a lot of people from India are dumping black money into that territory. And in that territory, there is no proper government or there is no proper tax administration. So, even though India is requiring any information regarding those persons from that country, we won't get it. So, their data will be confidential in that country. So, in those cases, that countries will be treated as notified jurisdictional area and it will be notified under this section. Okay. Once it is notified, a person in India, resident in India, making a transaction with any person located in NJA. That may be an individual, that may be a company, or that may be a permanent establishment of a foreign company located in another country. For example, a foreign company located in Dubai has a branch in NJA and Indian entity is carrying out transaction with that branch in NJA. This provision will be applicable. So, if you are carrying out a transaction with a person located in NJA, even though there is no associated enterprise conditions. So, what are associated enterprise conditions? Participation, capital, control, management, that 12 scenarios. So, any one of that 12 transaction does not carried out during the year. No 26% holding, no raw material procurement, no sale of goods, nothing like that. But still deemed to be AE. So, this entity, Indian entity, and that person located in NJA, they will be treated as AE, and whatever transaction they are carrying out, maybe accepting loan, giving interest, or giving loan and accepting interest, or payment of expense or receipt of income, whatever may be. Any transaction with such a person located in NJA will be treated as international transaction, and all the provisions of transfer pricing provision will be applicable except tolerance variation. Tolerance variation is that is arithmetic mean and actual transfer price. That variation does not exceed 3%. It will be accepted, right? That won't be accepted. If there is 3% variation, even though within 3%, TP adjustment shall be made. So all transactions and one of the parties located in NJ will be deemed to be AE, and all transactions deemed to be international transaction, and all TP provisions will apply except variation. And next consequences. Second consequence. See, all the transfer pricing provision will applicable means you have to prepare documents, you have to find out ALP, you have to make the variation, you have to repatriate the money, a secondary adjustment, primary adjustment, books, documents, penalty, everything will apply, even form number 3 CEB, everything. And second, if you are making a payment of expenditure to a financial institution located in NJA, that means Indian entity taken loan from a financial institution or a bank located in NJA. And we took the loan, we are making repayment. So we are making payment of interest expense. So that interest expense or that loan repayment, so for us, interest is the expense, loan repayment is not an expense debited to P&L, but interest will be debited to P&L. So such a payment will be disallowed, such expense will be disallowed unless the Indian entity gives a declaration and made a prescribed arrangement to the CBDT that if CBDT asking for any information from that financial institution located in NJA, that financial institution is bound to give whatever information CBDT is asking. So for that, first they have to make an undertaking, they have to make an agreement with the foreign entity that, see, if our CBDT asking any information, you have to give that. So only after giving that authorization or that prescribed arrangement, then only the payment of expenditure made to financial institution located in NJA will be allowed as an expense to the Indian payer, Indian entity. So disallowance of payment made to financial institution located in NJA unless assessee furnishes an authorization to income tax authority to seek relevant information from the said financial institution on behalf of such assessee. So whatever information which can be asked by Indian entity, that will be asked by CBDT also, and that other entity must provide. So if there is no such arrangement, this expense will not be allowed in India. And second, if the assessee does not provide the proper explanation regarding the source of money of the person located in NJA, Any liability which is payable to the NJA will be deemed as income of the Indian entity. That means Indian entity took a loan, huge amount of loan from a financial institution located in NJA. And CBDT is asking to give this much amount of loan to the Indian entity, that NJA entity, from where they get the money, who is funding them. So from where they are getting that much capital, from where they are getting the money. So ultimately, Indian black money will be converted and dumped into these territories, and that will be again converted to India as a foreign direct investment or something like that. So to prevent that circulation, they are saying, we need the source from where that money obtained by the person located in NJA. So that source should be revealed to the CBDT by the Indian entity. Otherwise, whatever loan taken from that entity will be treated as income of Indian entity. Very dangerous situation. Indian entity took a loan of 100 crore from an NJ entity, but they failed to disclose the sources of that NJ entity. In that situation, this 100 crore liability loan will be treated as income of Indian entity. Very dangerous. Amount received or credited from NJ will be deemed as income if assessee does not provide explanation for source of income or explanation not satisfactory in opinion of AO. And next one. Normally, to claim an expense in India, we have to maintain some basic information. To whom we are making the payment of expenditure, what is the nature of expenditure, where is the bill, bank statement, all those things we have to keep. In addition to that, if you are making any payment of expenditure to a entity located in NJA, for us it is an expenditure, for them it is an income. We have to maintain additional documents required by the CBDT, prescribed by CBDT. Only then that expenditure will be allowed. So no deduction of any other expenditure or allowance or depreciation arising to such a transaction unless assessee maintains, Indian entity maintains relevant documents and furnishes prescribed information. So additional expenditure and documents must be maintained. Then only expenses which is paid or payable to the NJ entity, which is an expense for the Indian entity, allowed subject to this additional documentation. And last, higher rate of TDS. When we are making a payment of expenditure to an NJA, the rate of TDS shall be normal rate or 30%, whichever is higher. So this 30% is the rate. So on this 30%, we have to apply cess also. This is the TDS rate, right? Only the TDS rate, not the tax rate. TDS we have to deduct at a higher rate. So if the NJ entity file the return, they can claim the actual tax. So excess will be, they will get the refund. But for the Indian entity, we have to deduct the TDS at a normal rate or 30%, whichever is higher. 30 is a very high rate. So even though it is a royalty, normal rate under as per section 115A is 20, but we have to deduct TDS at 30. If the interest is paid to an NJA entity which is invested in notified infrastructure debt fund, normal rate is 5, but we have to deduct TDS at 30. So higher rate TDS must be deducted. So this is another. So if we did not deduct a higher rate, what will happen? It will be treated as a non-deduction. If we deduct 20% instead of 30%, it will be treated as a non-deduction. The department can say that while computing your PGBP as per 40A1, we are going to disallow 100% of your expenditure. And their expense can be disallowed. Because PGBP there is a provision, if TDS is not deducted, it can be disallowed. Again, it is paid to non-resident. So 100% can be disallowed. So that is also possible. But there are two views. Short deduction and non-deduction is not same. In case of short deduction, only proportionate amount should be disallowed. In case of non-deduction, food should be disallowed. But there is another view, short deduction is equal to non-deduction and it should be disallowed. So different contradictory high court decisions are there. So two views are also possible. But anyway, higher rate of TDS will be applicable. This is 94A NJA. So this is the only privilege they are not getting in TP, that is 3% or 1%. That 1% is when it is related to a wholesale trading transaction. 1% is a tolerance band for arithmetic mean. It's not important. Generally 3%. So that 3% variation not available, even though we are taking arithmetic mean for an ALP for a transaction with the person located in NJA. And next is the another important area, that is thin capitalization, or we can say 94B, limitation of interest. Can we take a break? Yeah, after the break we'll continue. Okay. So only these 2-3 areas in TP, and we will do the remaining problems in TP. Then we will go to the double taxation relief. While studying or revision, remember to solve a question on double taxation relief, you should be well versed with the heads computation, salary, HP, PGBP, capital gain, IFOs. You should be very clear about set off. You should be aware about basic chapter 6A reductions available to individuals and HGF, because majority of the DT problems are asking for individuals. So we need to study that ATC, CCCD, all those chapter 6A, you should be aware. So then only we can do the problem. And one more thing, if assessee is a resident, income is received from foreign country, that will be in dollar, pound, euro, that should be converted into INR. So we should study that rule 115 also, how the foreign income should be converted, because for new syllabus, they included that rule in our syllabus. But for the old syllabus, question will give the exchange rate. But here we have to know in which date, whose exchange rate will be taken. They will give SBI rate for different dates. So which date should be taken? So that should be aware of. Then only we can solve the problem properly. And recently DTA problems are not asking for symbol level. Whatever questions available in the study material is symbol. But the questions they are asking for exam is tougher questions. Okay, so that should be careful. So after DTA relief, I think the major area of international taxation we will cover. Okay, and tomorrow onwards we will do the balance topics. Okay, so next is limitation of interest, section 94B. The 94B section, what it says when an Indian entity making interest payment to non-resident including AE, the total interest paid including AE interest should not exceed a particular limit. That limit is 30% of EBITDA. EBITDA means earnings before interest, tax, depreciation, amortization. Okay, suppose if the total interest including AE interest, total interest means sometimes there may be interest debited to P&L which is paid or payable to Indian residents, maybe bank interest, non-AE interest, or maybe AE interest. You should take the total. AE interest as well as non-AE interest, total interest debited to P&L should not exceed 30% of EBITDA. If it exceeds 30% of EBITDA, out of that excess, AE interest will be disallowed. So this disallowance will never applicable for non-AE interest, but for computing the 30% of EBITDA, we will consider total interest. Whether it exceeds 30%, we will consider total interest. But disallowance applicable only for AE interest. AE interest, that means interest paid or payable to AE. And this section applicable for where the payer or the borrower is Indian company or permanent establishment of a foreign company. So not only for residents, even for non-residents also this section is applicable. That is, one non-resident is paying interest to another non-resident, but the payer non-resident is located in India. In that situation also it is applicable. That is why PE, permanent establishment of a foreign company. A foreign German company set up a branch in India, and that branch is taking a loan from Japanese company and paying that Japanese company and German company is AE. So this Indian branch is paying interest to Japanese company. This section is applicable. So that is PE of a foreign company or Indian company. And what is paying? That is interest. So for paying interest, they are taking loan or debt. So it may be debentures or it may be deposits or it may be loan. So Act uses the word borrowing, loan or debt. So interest or similar nature. So any amount in the nature of interest. So there are certain contradictory decisions whether guarantee fee can be treated as an interest. So in the latest decision, court says guarantee fee cannot be treated as an interest. So interest, actually debt, in return we are paying interest. And total interest to the associated enterprise should exceed rupees 1 crore. So to attract section 94B, lot of conditions, there is a monetary limit more than rupees 1 crore. If the interest is paid or payable to the AE should exceed rupees 1 crore. Total interest may be more than 1 crore, but if the AE interest is less than 1 crore, this provision is not applicable. And who is the lender? That is, who is the person getting the interest income from India? That's lender is a non-resident associated enterprise of assessee, or sometimes directly not an AE of Indian entity. It's a third party. For example, an American bank granting loan of rupees 10 crore to an Indian company. Indian company took a loan of 10 crore from American bank, Bank of America. There is another company in America which is an associated enterprise of Indian company. Say X Incorporation US. So Indian company Indy Limited. So Indy Limited is took a loan of rupees 10 crore from Bank of America. At or about the same time, simultaneous same time, there is another American company which is an associate enterprise of Indy Limited, that is X Incorporation. That is X Incorporation made a deposit of rupees 10 crore with the Bank of America. So we took a loan of 10 crore from Bank of America. At or about the same time, an equal or matching amount is deposited by our associate enterprise in that bank. If this happens, this American bank and this Indian company Indy Limited will be deemed as associated enterprise only for the limited purpose of this section 94B. So they are clearly saying not an AE, the lender is not an AE, but lender have been guaranteed by AE of assessee. That is X Incorporation US company is an associate enterprise of Indy Limited. That X Incorporation gives a guarantee to Bank of America an equal amount of 10 crore or deposited a matching amount from an AE of assessee or similar amount is deposit, put a deposit in Bank of America. Maybe they are getting interest for that deposit, but anyway, the loan amount and deposit amount is matching. Then instead of giving direct loan, they are routing through third party. That is the idea. So even though it is not like that, so if this happens, that third party will be treated as deemed to be associated enterprise. So this provision not applicable in other cases. This deemed AE concept applicable only in 94B. This particular deemed AE applicable only in 94B. And the total interest paid or payable exceeds rupees 1 crore to AE. And we are claiming that interest deduction under PGBP. That means as per the provisions of PGBP, it is allowable expense. That interest is allowable. To claim an interest under PGBP, basically there are two conditions. Number one, that loan amount must be used for the purpose of business. And second one, when we are making interest to non-resident, we have to deduct TDS. So PGBP provisions complied. So this is an expense allowable under PGBP. But AE interest exceeds 1 crore. Including AE interest, total interest, if it is exceeds 30% of EBITDA, out of the excess interest, what is AE interest included in that excess amount, that will be disallowed. So they are saying in another way, total interest in excess of 30% of EBITDA. Remember, total interest means interest to AE as well as non-AE, exceeds 30% of EBITDA, or interest paid or payable to AE, whichever is lower, should be disallowed. But if the Indian entity, that is a borrower entity, the main purpose of Indian entity is engaged in the business of banking or insurance, then it is active business. As part of their active business, sometimes they will took a loan from AE, no problem. This section is not applicable. So the borrower entity should not be engaged in the business of banking or insurance. So we can say a lot of exception. If the interest paid or payable to AE does not exceed 1 crore, this provision not applicable. If the payer engaged in the business of banking or insurance, this provision not applicable. Even though interest exceeds 1 crore, total interest does not exceed 30% of EBITDA, this provision not applicable. All these conditions cumulatively satisfied, then excess interest will be disallowed. How the excess interest will be calculated? First, we should find out what is the total interest exceeding 30% of EBITDA, then compare that amount with the AE interest, whichever is lower. Or in other words, we can say that AE interest as well as non-AE interest should exceed 30% of EBITDA. Out of that excess amount, AE interest will be disallowed. And this disallowed amount is not a permanent disallowance, it is a temporary disallowance. Once it is disallowed, this disallowed amount can be carried over to the next year. Just like carry forward of loss. It can be carried forward to next year. So suppose in the current year, if 2 crore is disallowed, that 2 crore can be carried forward to next year. And in the next year, if your total interest does not exceed 30% of EBITDA, say next year, your total EBITDA is 100 crore, 30% of EBITDA is 30 crore. But next year, your total interest is only 28 crore. So not reaching the limit of 30% of EBITDA, there is a gap. To that gap, you can set off this carryover interest in the next year against the PGBP income. So disallowed amount can be deducted next year along with the next year's interest up to maximum of 30% of EBITDA. So in the next year also, if you have disallowance under 94B, again it should be carried forward. No other way. So next year should not be disallowance and your total interest does not reach 30% of EBITDA. There is a gap is available. So to that extent, you can set off this carryover interest. Maximum 8 years you can carry over. Within 8 years, you cannot absorb this interest, it will lapse. So this is section 94B provision. And what is EBITDA? Earnings, that is profit, before claiming interest, before claiming tax, before claiming depreciation. Depreciation includes additional depreciation also. And before claiming amortization. Amortization, we can say that under PGBP there are certain amortizations. So one such amortization, we can say that section 35D is an amortization. 35D, amortization of preliminary, and section 35DD, amortization of amalgamation or expenditure. 35DDA, amortization of VRS compensation paid, and 35ABA, amortization of telecommunication license fees paid. 35ABB, spectrum license fees paid. So these are the amortizations. So amortization. So if the P&L account debit with the 35D, DD, DDA, 35AB and ABB, it should be add back. Depreciation debited to P&L, add back. Tax, add back. Interest, total interest, whether AE or non-AE, full interest add back to the net profit. You will get EBITDA. So once we got the EBITDA, then find out the percentage, that is 30% of EBITDA. So if the interest exceeds 30% of EBITDA, out of that excess interest, compare with the AE interest, whichever is lower should be disallowed. This is 94B, limit of interest reduction. So this is a very important provision. Sometimes they may ask a problem, or if it in MCQ, see these limits. Okay, total interest should exceed 1 crore in this particular limit. So then only disallowance is applicable. And remember, these things carry forward. So maximum 8 years you can carry forward, and you can set off to the extent of the next year's interest is fall short of 30% of EBITDA. To that efficiency you can adjust. Balance again carry forward. Maximum 8 years, and it can set off only with the PGBP. Remember, next year's interest, this can set off only with the PGBP, right? Any other business also possible. It cannot set off with any other heads. And now we can finish the balance questions in TP. So first we will take question number 10. Paras Limited is an Indian company engaged in the manufacture of supreme quality mink blankets. It has total borrowings of rupees 60 crore by way of loan as on 31st March 25. Saksham Limited of Germany imported 5 lakh blankets from Paras Limited for the resale in Germany at rupees 2000 per unit. Paras Limited sold similar blankets to other dealers in Germany at rupees 2100 per unit. So we have to find out arm's length the price, and we have to find out the primary adjustment, and we have to see whether it is more than 1 crore, whether secondary adjustment is applicable, then how the secondary adjustment will be done. All these are included in one question. So 2100 is the unrelated party's price. So related party 2000. Paras Limited received a bank guarantee on 1/4/2024 for availing a cash credit limit of rupees 9 crore, for which Saksham Limited was the guarantor. How Paras Limited and German company become AE? So we have to check this. Total borrowings of the company, Indian company, is 60 crore, right? So 10% of 60 crore is 6 crore. They are giving guarantee for at least 9 crore. That is more than 10% of total borrowings. The other company is giving guarantee. One of the situations under section 92A, deemed to be associate enterprise, any one of the transaction carried out. One of that case is here. So they are AE. Okay, that is AE point only. First one is goods transaction. That is for finding out the ALP. Second one is how they are become AE. The terms of trade for other dealers was to make payment within 1 month from the date of sale of goods by Paras Limited, whereas for Saksham Limited, the credit period allowed was 3 months for the date of sale of goods. So only in one case there is a payment within 1 month, and another case there is a credit period is allowed. The cost of capital was 12% per annum, and the supply of goods is assumed to be uniform throughout the year. So the major difference is this particular cost of credit is the material difference we have to adjust. We can apply comparable uncontrolled price method. We have to adjust this material difference. We will get the arm's length price. You are required to determine whether Paras Limited and Saksham Limited are associate enterprise. Yes, that we already discussed. They are associate enterprise because Paras Limited got the guarantee from the German company to the extent of more than 10% of their total borrowings. So they are AE. If yes, compute the arm's length, the price of the transaction between them, and the amount to be added to the income of Paras Limited, if any, by way of an ALP adjustment. That is speaks about TP adjustment variation. Definitely there will be a TP variation. We have to find out that. Then we have to check whether that amount is more than 1 crore. Then only we can answer this next part. Assuming that the above adjustments to the transfer price have been made suo motu by Paras Limited in its return of income. What is the time limit for the repatriation of such excess money? Okay, if it is suo motu made by Paras Limited, the time limit is allowed is within 90 days from the due date for filing ITR. 30th November plus 90 days. Okay, next question. What are the implications if the excess money is not repatriated within such a prescribed time limit? So we have to tell all the implications. So if they did not repatriate it, will be treated as a deemed loan and interest will be calculated. Depends upon whether the international transaction is denominated in Indian currency or foreign currency. We have to take SBI rate plus 3.25% or the Libor rate plus 3% that we have to take. Depends upon how the transaction is denominated. And again, we can say the other option, they can pay additional tax at the rate of 18 plus 12 plus 4 so that the provision will be concluded. Okay, so that we have to find out. So first we have to find out the arm's length price. So the related party, that is in this case 60 crore, okay, German company number 5 lakh blankets from Paras Limited for the resale in Germany at 2000, that is a TP. The unrelated party price is 2100 per unit. So first we should find out the unrelated party. So first we should say that AE condition we have to put it. So here it is at least 15% of the total borrowing, 9 crore out of 60 crore. So they are AE. That we should mention. And then computation of arm's length, the price of transaction within Paras Limited and Saxon Limited. Selling price of each blanket to unrelated parties in Germany 2100. Then there is only one material difference is there, that is adjustment of cost of credit. Paras Limited provides credit for 1 month to unrelated entity, whereas it provided credit period of 3 months to Saxon Limited. Therefore, adjustment for the cost of such a credit to be carried out to arrive at arm's length price. So 12% into 2100 into 2 by 12. Therefore, 2 months is the additional, right? 3 months and 1 month. So that should be added. So we got the arm's length price of 1 unit of blanket 2142. But what we are charging is only 2000. So there is a variation of 7 crore 10 lakhs. 7 crore 10 lakhs is the transfer pricing variation which has to be done. So 7 crore 10 lakhs means it is more than rupees 1 crore. If the primary adjustment is more than rupees 1 crore, secondary adjustment is applicable. This rupees 7 crore 10 lakhs should be repatriated within November 30 plus 90 days. November 30 plus 90 days means you have to count that date. December 31, January 31, so 62, and February 28. So within February 28, they have to repatriate 7 crore 10 lakhs into India. In addition to TP adjustment and paying tax, further I have to repatriate this money. So if this money is not repatriated within 28 February 2026, then it will be deemed as a loan given by Indian entity to the AE and deemed as a loan, and interest will be calculated. As this in this case the transaction is denominated at Indian rupee, we can say that SBI lending rate as on 1/4/2025 plus 3.25. Remember 1/4/2025 because we are calculating interest for the period of 24. Not for 24-25, in 25-26 because due date is in 2025 November 30. So 90 days period expired on 28th February 2026. So the financial year for which we are calculating interest is 25-26. Interest should be calculated from 1st December onwards, not from 29th February or not from 1st March. Interest should be calculated from the due date for filing ITR. That specified date we have to calculate the interest. So that is 1st April 2025 onwards we have to calculate the interest. And the rate will be 1/4/2025. What is the marginal cost to fund lending rate of SBI plus 3.25. And it will continue till the money is repatriated, but usually we are computing income year wise. So for the previous year 25-26, interest will be calculated from 1st December to 31st March 2026. Then still not repatriated next year 26-27. The entire year we will again calculate the interest for this money, but at that time the rate will be taken on 1st April 2026. What is the SBI lending rate plus 3.25. Likewise, it will continue till the repatriation. But to escape from and to close the case, last resort, pay additional tax. So additional tax will be for this 7 crore 10 lakhs rupees into primary adjusted amount, 7 crore 10 lakhs into 20.9664%. They can pay additional tax. Once they paid additional tax, the entire adjustments will be deemed to be concluded. And further, there will be no treatment, and further will be no deemed loan and interest approach. It's closed. So I don't remember, this is an old RTP question, but that question contains all the aspects. That's why I selected that question. So this is a provision on secondary adjustment. Next question, 11th question, that is on 94B, limitation of interest. So we are going to solve that question. 11th question. And the next two, three questions are actually based on, that is double taxation avoidance agreement. Okay. See question number 11. Yeah. So on 23rd June 2024, R Limited, 23rd June 2024 means our current year, 24-25, an Indian company borrowed 100 crore rupees, 100 crore from MPT Limited, a company incorporated in Singapore. Okay, borrowed 100 crore. The said loan is repayable over a period of 6 years. This loan is guaranteed by L Limited, a company incorporated in USA. L Limited holds 30% shares in R Limited. Okay, so here the party in Singapore is unrelated party actually. MPT Limited is an unrelated party that is located in Singapore. From that MPT Limited, this Indian entity borrowed a loan of 100 crore. So there will be no AE, but the problem is, yeah, it is the set loan is repayable of 5-6. This loan is guaranteed by L Limited, a company incorporated in USA. L Limited USA and R Limited are AE because 30% shares are held by L Limited in R Limited. So for the purpose of section 94B, M Singapore and R Limited are deemed to be associated enterprise. First we have to write that how they become AE, because directly they are not AE. So we studied the provision how they become AE. So that equal amount is deposited or guarantee is given. That is a condition. Equal amount is deposited or guaranteed. Not an AE, lender is not an AE, but lender have been guaranteed by AE of assessee, in this case L Limited, or lender should have been received deposit matching. Here guarantee provided. So that is why it is AE. Otherwise they are not AE, right? Now what? The position of the Indian company R Limited, 23, 24 and 24, 25, 2 years details is given. So we need the current year data, that is 24, 25. That is our current year. So employee benefit expense, interest paid to MPT Limited, 238, depreciation, income tax, profit transferred to reserve. And gross profit, 1,630. Calculate the income under the head profits and gains from business and profession of R Limited for assessment year 2025-26, assuming gross profit is calculated as per the provisions of income tax. Gross profit is calculated as per the provisions of income tax, not the profit transfer to reserve. Gross profit is calculated as per. That word is very important, right? gross profit is calculated as per the provisions of income tax, and depreciation is also as per income tax rules. Give appropriate reasons of your workings. Assume none of the companies are engaged in the business of banking. So first you have to start from here, that is 1630, that is the net profit or GP computed as per the provisions of the income tax, 1630. So after this 1630, they debited employee benefit expenses, interest paid to M, depreciation, income tax, and profit transfer to reserve. So we need the EBITDA means earnings before interest, tax, depreciation, amortization. So in this 1630, they don't debited these things. If we are taking the net profit here we have to have 1550, right? Yeah, not this. So this 1550 is gross profit before debiting this. So if we are taking this 525, we have to add back all these things. So if we have to taking the gross profit, we have to reduce only the employee benefit, we have to reduce, so that we will get the profit, EBITDA. We will receive directly the EBITDA. That is employee benefits we have to reduce. That is 301. So we will get the EBITDA. Or you can do like this. If you taking the net profit 525, if you are taking, then add to the 525, add income tax 232, depreciation 254, interest 238. That also we will get the EBITDA. So what is the EBITDA? 1249. Here also same, right? So two ways you can do. Depends upon which profit you are taking, whether you are taking net profit or whether you are taking gross profit. Okay. So this is EBITDA. So EBITDA into 30%. So what is EBITDA into 30%? 374.57. Yeah, this is 30% of EBITDA. So whether the interest exceeds this 30% of EBITDA. So interest is 238. So interest paid to MLIM PT Limited for the current year 24-25. This 238 does not exceed 30% of EBITDA, because only the total interest is 238. It is less than this 238. Total interest is less than 30% of EBITDA. That means 24-25 there is no disallowance. But the problem is they are giving the details of 23-24. That means at that time you should remember, okay, then we have to check whether 2023-24 there is a disallowance. If there is a disallowance in 23-24, that can carry forward and current year we can set off. So go back to 23-24. So 23-24, 1650 is the gross profit, 1650. So reduce employee expenses, that is 280, right? So what is the EBITDA in last year? 1350. 1630. Yeah. 1630, right? Yeah. Okay. 1350 EBITDA in last year. Okay. Into 30%. How much? 405. So last year it is 589, which exceeds 30% of EBITDA. How much is excess? 184. 184 or 589, whichever is lower, to be disallowed under section 94B. So 184 is lower. Here there is no other interest, only A interest is there. If there is another interest, that would always be considered for 30% in exceeding EBITDA purpose. But here only A interest is there. So 184 or 589, whichever is lower. 194 to be disallowed. So first we should do the computation for previous year 23-24. Previous year 23-24, we can directly take the net profit. So the net profit is 240. Net profit is 240. Employee benefit is allowed under income tax. Out of interest, we are going to find out the disallowance. We are going to make the add back. Depreciation as per income tax allowed. Income tax is not allowed under IT Act. So add income tax. Income tax is not a business expense, 271. Remember, I am considering 240. So 271 add back. And then 94B disallowance. How much? 184. So what is the PGBP income for that year? 23-24. PGBP income for 23-24. 695. That will be PGP. And now remember one important point. This 184, even though add back, it can carry forward to next year. So this 184 will be carried forward to current year. So in current year, the EBITDA amount is 1249. 30% of EBITDA 374.7. Your total interest can be up to 374.7. But in the current year, it is only 238. So what is the difference? What is the difference? What is the difference? 136.7. So up to 136.7, this 184 carry forward in the last year, you can set off in the current year. So out of 184, 136.7 can be claimed in the current year. So in the current year, we have to take the net profit. So current year PGBP income 2425. What is the net profit of the company? That is 525. Out of that 525, add back IT. IT is not allowed as a business expense, 232. And there is no disallowance. And now we can claim deduction. Less 94B shortfall of last year, we can set off in the current year 136.7. This we have to reduce. Get the PGP income. So what is the current year PGP income? 620, 1.620.3. So this is the current year income. And one more thing you have to write, out of 184, 136.7 is set off in the current year, remaining again to be carried forward 47.3. That should be carried forward to next year. So here some sort of a PGBP computation adjustments is also appearing. So they are asking total PGP income also. So this is an exam question they asked recently. So that area is over. So these are the main area you have to keep in mind in transfer pricing, especially 94B, 92C is secondary adjustment, 94B limitation of interest, 94A notified jurisdictional area, 92C is secondary adjustment, and usual area, that is computation of arm's length price under different methods. These are the core problem area for transfer pricing. And for theory area, that advanced pricing agreement is an important area for transfer pricing theory, advanced pricing agreement, and then documentation, maintenance, reporting, and penalties. These are the core theory area. So if they are asking a big problem, they won't ask a theory. If they are not asking problem, they will ask theory. See, in a particular situation, there is only interest to non-AE, no interest to AE. This section not at all applicable. No need to check this. Yeah, AE and non-AE is available. To both of them, we are paying interest. For the purpose of excess interest calculation, in excess of 30% of EBITDA, we have to consider both. Yeah. That is a provision says. For excess interest purpose, we have to calculate both. So total interest means AE interest, total interest means AE interest plus non-AE interest. If that exceeds 30% of EBITDA, that is amount 1. Now compared with the AE interest, whichever is lower. So the basic idea is only AE interest will be disallowed. Only AE interest will be disallowed. But if AE interest, how much AE interest to be disallowed? That depends upon total interest exceeding 30% of EBITDA. So if AE interest is 0, no disallowance, even though total interest exceeds 30% of EBITDA. Now, these are the core area in TP, right? So TP and not taxation. I think you got an idea. Now we are moving to double taxation relief or double taxation avoidance agreements. So how double taxation arise? Basically, to tax an income, there are two basic rules followed all over the world. Every country is following these two rules. One is residence rule and another one is source rule. Residence rule means it is immaterial from which country you earned the income. It is immaterial from where the source of income is coming. It is material in which country you are resident. So residence country has the right to tax all income earned by that person, irrespective of the country of source. That is known as residence rule of taxation. And what is source rule of taxation? Source rule of taxation says we are not worrying about in which country you are resident. If you earned income within our jurisdictional territory, source is in India or source is our country. So you have to pay tax here. So even though you are a non-resident, for Indian income, you have to tax in India because we are applying source rule of taxation for non-residents. And if you are resident, you are earning income from South Africa, you have to pay tax in India. At that time, we are applying residence rule. So simply speaking, for residents, taxing residents, India is following residence rule. And for taxing non-residents, we are using source rule. So India is using a combination of residence rule and source rule. So in those situations, for the same income, country of source applied a tax based on source taxation rule, and country of residence is different, and that country of residence taxed that income based on residence rule, there arise double taxation. So for the same income, for the same person taxed in two different countries, that is known as jurisdictional double taxation. In case of jurisdictional double taxation, we can claim double taxation relief. Act purposefully uses the word double taxation relief. Sometimes they will say double tax avoidance, but that is not real. They are not giving double taxation avoidance. They are giving some relief only. Anyway, income is taxable in both countries. In one country, the tax paid in the other country will be allowed as relief. So that is why it is known as relief. Very rare situation, exemption will be given. Only income will be taxed only in one country, and in the other country it will be completely exempted. In that case, actually double taxation avoidance happens. Rarely. Majority cases we are getting relief only. So total there are three sections incorporated in the income tax law: 90, 90A and 91. 90A is literally unimportant because that is specifically applicable to certain selected persons only to get the relief. So that is not relevant. So main is 90 and 91. So section 90, what it says? As per section 90, to promote mutual economic relationships and to promote mutual investment, trade, etc., central government has the power to enter into double taxation avoidance agreement with different foreign countries or territories outside India, as per Indian Constitution. So by obtaining the power from Indian Constitution, Income Tax Act created section 90. Under section 90, subsection 1, which says that central government has the power to levy double taxation avoidance agreement with the foreign country. What are the objectives? That is for DT relief, promote mutual economic relations, trade, investment, exchange of tax information, prevention of tax evasion or avoidance. These are the objectives for which DT agreement is entered into. So not only for the purpose of double taxation relief, there are a lot of other objectives for DT relief or double taxation avoidance agreement. That is promote mutual economic relations, trade, investment, prevention of tax evasion. All those are objectives of a DT agreement. And 90 subsection 2. See, by obtaining power from 90 subsection 1, almost more than 100 countries. India have double taxation avoidance agreement with more than 100 countries. Some DT agreements are very detailed agreements. Some are very limited agreements. So some are comprehensive agreements. So more than 100 countries India have DT agreements. Or by using this power, India is entered into. And now what section 90 subsection 2 says? 90 subsection 2 is very, very important for the purpose of this DT relief or for this chapter or for your practical knowledge also. Remember, 90 subsection 2 is very, very important. What this section says? This section says whenever a conflict arises between the provisions of taxation as per DTAA and the provisions of taxation as per the domestic law, that is in Indian's perspective, Indian income tax law says a provision, but that provision is contradictory to the provision contained in DT agreement. Domestic law, Indian Income Tax Act says that 115A says if a non-resident getting royalty from India, it will be taxable at a flat rate of 20%. 115A. At the same time, if that non-resident's country and India entered into DT agreement, and that DT agreement article 11 or 12, which says that if the resident of that foreign country getting royalty from India, it should not be taxed more than 10% in source country or India. Conflict. Domestic law section 115A says it can be taxed at 20%. Same time DT agreement says no, it cannot be taxed more than 10% in your country. Conflict. So whenever there is a conflict, the beneficial provision to assessee will prevail. So which is beneficial for non-resident, to tax at 20% in India or to tax at 10%? To tax at 10%. So DT agreement will override income tax law. So this is the only provision based on which all the big fours are giving tax consultancy to MNCs. Because all MNCs are, you see, majority of the MNCs who are making large investment in India, they will put on a country where there will be a favorable DT agreement exist. So that is not treaty shopping like that. So this provision is very important. So even though Income Tax Act say 20% surcharges, we will tax you. So DT agreement simply sitting and smiling. No, you will do nothing, man. Domestic law 115A say it will be taxable 20%. But DT agreement says no, it will be taxed only to the residence country. It won't be taxed in source country. No tax at all. Mauritius, Singapore, to some extent Netherlands, Antilles, very favorable provision. So KPMG or EY, they will say to the company, don't start your operation from US. Go settle your office or company in Mauritius or Netherlands, Antilles. Then route that activity to India and get the favorable advantage of DTA. So no need to pay tax in India. So any provision, whatever provision is saying in income tax law, everything will be overridden by DTA agreement if it is favorable. But some other conditions is there, that non-resident has to prove that I am from this country. So he has to prove the residence by giving the tax residency certificate and other prescribed particulars. Then only he will get the advantage. But anyway, that is only procedural complaints. Definitely they will do that. So they will take the advantage. So this provision is very, very important. But in only one situation, this provision cannot be taken. That is when the GAR provisions are applicable. General Anti-Avoidance Rule. GAR provision. That is when a person is doing an impermissible tax avoidance arrangement in India, that is some fraud is carried out, not a tax planning, but a tax evasion according to Income Tax Department. They made the primary verification that declared the transaction carried out between that persons are impermissible tax avoidance arrangement. Then the provisions of GAR will apply, or the Income Tax Act chapter 10A. Chapter 10A means GAR provision will apply. If GAR provisions are applicable, then you are a fraud person in the eyes of income tax law. Whatever beneficial provisions available, that will be taken away. And then at that time they are saying if GAR provisions are applicable, then DT agreement will not come to rescue. Income tax provisions only will be applicable. Except in those cases, very rarely GAR is applicable, right? Because of this Vodafone case, they are putting GAR provisions into it. But there are numerous conditions to declare an assessee as a GAR under the GAR provision, or to declare the transaction to impermissible tax avoidance arrangement. It's very difficult. So practically, I think even though inquiry is happening, it will not reach the final stage. Before that, it will drop. Again, it will give some bad message to the investors, right? So some multinational companies, they will be reluctant to invest in India, right? So the government will not go to that extent, but still provision is there. So 90 subsection 2 favorable provision not applicable if GAR applies on assessee. So in all other cases, 90 subsection 2 is a biggest advantage, because whenever we are deducting TDS under section 195 for a payment made to non-resident, we must check this provision, whether that income is covered under DTA, whether the rate as per DTA is lower than the normal rate, then we should apply that favorable rate. So we should deduct TDS only that lower rate. So if the DTA agreement says that it is not at all taxable in India, then no need to deduct TDS. So while giving the certificate by chartered accountant, we will say no, due to this provision it is not taxable in India. So tax residence certificate and all other details has been obtained. So TDS is not applicable. We can make the payment without TDS. So this is 92 and 2A. And now 90 subsection 3. Normally double taxation avoidance agreement is a detailed agreement containing around 30 or 31 articles. Depends upon whether it is OECD model DT agreement or whether it is a format of UN model. Depends upon that, article number will vary. But in every double taxation avoidance agreement, the keywords used in that agreement will definitely defined in the agreement. For example, royalty. What is the word meaning of royalty? We cannot take the general meaning. DT agreement uses royalty, it will define what is royalty. Dividend, it will be defined in the DT agreement. So what is a permanent establishment? DT agreement will define. So if a word used in the DT agreement is not defined in the DT agreement, then we can take the meaning as per the domestic law. So if there is no meaning in DT agreement and no meaning in domestic law, central government can give a definition to that word by mutual negotiation. With that country, they will discuss, see, there is a word used in our DT agreement, but that is not defined. Can we give an explanation to that meaning or that word? If both the countries agrees, they will arrive at a meaning and it will be notified. But if any meaning is given in the DT agreement, then you cannot take income tax meaning or dictionary meaning or general clauses meaning or constitution meaning or Wikipedia meaning. You can't take that. If a word is used in DT agreement gives a definition, take only that definition. So by interpreting definition, a lot of assessee will get benefits. So terms in DTA not defined in Act or DTA, meaning can be given by central government through notification. And 90 subsection 4 says that to get DTA benefit, that is 90 subsection 2 benefit, to get that favorable position, TRC is mandatory, tax residency certificate is mandatory. But if TRC does not contain a lot of relevant information, then you have to give additional information in the form of Form 10FA should also be filed. So TRC plus additional information required by CBDT should be given, like name of that assessee, country of residence, TRC period, address in that country, equivalent to PAN in India, what is the tax identification number in that country, what is the constitution of the assessee, whether it is a company, firm or LLP, so email ID. So those type of details in that country should be given. So that is additional particulars. And these are the main sections of 90. 90 subsection 1, 2, 2A, 3, 4, 5. Simply speaking, 90 says regarding bilateral relief. Bilateral relief means if there is a DT agreement, there is two party, India and a foreign country. So residents in India or residents in that other country, both will get the benefit through DT agreement. That is why it is known as bilateral relief. Residents of both countries, that means residents of both the states. Both the states means contracting state and other state. That means the signatories of that agreement. So India and Mauritius, if there is an agreement, India, for an Indian resident, India is contracting state and Mauritius is other state. If the other person is resident in Mauritius, then Mauritius is his contracting state, India is other state. So likewise, in both states, persons will get the benefit. That is why it is known as bilateral relief. But if there is no double taxation avoidance agreement, for double taxation relief will be available only to Indian residents. That is section 91. 91 says where there is no DT agreement, but you are an Indian resident, paid tax in a foreign country, and that income is taxed in India also because you are resident. No need to worry about that. Go to section 91, claim relief. So if there is no DT agreement, non-residents won't get benefit. Only residents will get benefit. That is through 91. That is when 91 is known as unilateral relief, but 90 is known as bilateral relief. And now some explanations given under section 90. First is taxing a foreign company at a rate higher than domestic company shall not be treated as a less favorable tax treatment. So to understand better this provision, I will explain another thing. Every double taxation avoidance agreement contains a particular article known as non-discrimination article. In that non-discrimination article, which says that while taxing a resident along with a non-resident, if both are doing the same activity and the same category, there should not be a discrimination in taxing that two assessees. That is, Indian company, they are allowing an expense, foreign company not allowing an expense. Indian company taxing at 25%, foreign company taxing at 35% or 40%. So now it is 35%. So such a type of discrimination should not be made. That is, non-discrimination article says. The problem is, see, under the tax law, always the rate of tax for a foreign company is usually high compared to domestic company. Domestic company, the rate of tax is 15%, or some case 22%, and some case 25%, and some case 30%. Total 4 rates is there: 15, 22, 25, 30. But for foreign company, the rate of tax is 35. Some incomes are taxable at flat rate 20, 115A, or some may be 5 or 4 or 9. But normal rate of tax is 35. So if we see 35 is more than 25. So definitely this non-discrimination article will apply. So central government cannot collect 35% tax on foreign company. This will be a big problem. So they already put a provision in advance under 90 stating that see 35% is equal to 25%.
35. 35 is equal to 30. 35 is equal to 15. To that extent, please don't cry. 35 is equal to 25. Mathematically, it won't work, right? 35 is not equal to 25. They are putting a provision. So we cannot apply non-discrimination article to the extent of taxing a foreign company at a rate higher than Indian company. So that will be equal to domestic company tax. That's the idea. See, earlier, if you analyze the income tax law, the tax rate of a foreign company is not higher. Domestic company, earlier their tax rate is 30. Domestic company's rate of surcharge is higher, 7% or 12%. Domestic company has to pay buyback tax. Domestic company has to pay dividend distribution tax. I'm saying the old position, not the now new position. Now there is no DDT. Now there is no BBT, right? Buyback tax. So earlier, all these taxes are applicable only for domestic company. If you apply all these tax, the rate of tax will go above 40. So we can say that actually the foreign company's rate of tax, if you consider the collectively all the taxes together, including surcharge, the rate of tax of a foreign company is not high. Just comparing the basic rate of tax without considering additional taxes, then it's correct. Foreign company's rate of tax is high. But anyway, they put an advance provision. So taxing a foreign company at a rate higher than domestic company shall not be treated as less favorable tax treatment. So remember, to this extent, article of non-discrimination article cannot apply, because what section 92 says, provisions in DTA and Act, whichever is more favorable should be applied. DTA agreement say should not make non-discrimination. Okay, don't make discrimination, right? But here it says 45% or 40%, 35% is equal to 25%. So to that extent, it's actually a discrimination. So if we apply DTA agreement, central government cannot tax foreign companies at 35%. That is why they put this clause. So now it's clear. Rate of tax higher than domestic tax should not be treated as less favorable treatment for that foreign company. Second one, there are certain specific territories outside India notified by central government for the purpose of entering into DTA agreement. Usually, central government can enter into DTA agreement with a country outside India. But there are a lot of other areas which is not a country. International community not accepted it as a country. Some territories, Hong Kong, Bermuda Islands, Netherlands Antilles. So those are the examples of some territories. But with that territory also, central government has the power to enter into DTA agreement. That is explanation 2 says. Explanation 3 of section 90 says that notification issued under section 90 subsection 3 deemed to be valid from the date of DTA agreement. Original DTA agreement drafted in 1995. At that time, there is used the word royalty. The word royalty used in DTA agreement has not been defined in 1995. Not in the agreement. There is no definition in the agreement. 2005, central government allotted a meaning through notification for the word royalty in that agreement. 2005. Even though this explanations coming or notification put on 2005 only, but it will be deemed to be valid from 1995. That is the original year in which, original date on which DTA agreement came into effect. So all the meaning, even though later on assigned, it will have a retrospective effect. So accordingly, if a person wrongly availed any benefit, you have to pay tax. So that's the impact. So notification issued under section 93 deemed to be valid from the date of DTA. And terms defined in DTA, you must take the meaning as per DTA. Not defined in DTA, then meaning as per Act plus notification. If there is notification is given, notification meaning. If no notification but meaning is defined under the domestic law, income tax law, no notification is prescribed and no definition available in DTA agreement, but word is used in DTA agreement, no definition is explained, then take the meaning as per Domestic Act. Domestic Act means Income Tax Act. So these are the major structure of the provision 90 and explanation. And now how the double taxation relief is given as per section 90. Through 90, how the double taxation relief is given. So through section 90, double taxation relief can be given in basically through two methods. One is exemption method and another one is tax credit method. Exemption method is the best, but only few agreements contains exemption method. Majority of the India's DTA agreement contains tax credit method. So exemption, there are two types of exemption. One is full exemption method. Full exemption method means income will be taxable in residence country. It will be exempted in fully exempted in source country, or sometimes ulta. It will be taxed in source country. It will be completely exempted in residence country. So that is full exemption method. So if there is full exemption method, assessee will completely get double taxation avoidance. but very few agreements contain full exemption method. Only with developed countries DT agreements contains full exemption method. India is a developing country, so India is not promoting full exemption method. India is promoting tax credit method, so that both country will get some benefit. And there is another method, exemption with the progression. Exemption with the progression means income earned in source country is taxable in source country. Income earned in source country is taxed in source country, but in the residence country, that income can be included only for the purpose of tax rate purpose, or for the purpose of computing the tax rate, it will be included. It won't be taxable. For example, India is residence country. There is another country, country X, source country. So a person got an income of 5 lakhs from that source country. As per the agreement between India and that country X agreement, which says that income will be taxable in country X. That 5 lakhs will be taxable in country X. But in India, that 5 lakh can be considered for rate of tax purpose. That means, in this example, his foreign income 5 lakhs. What is his Indian income? You have to compute the total income of that person in India. Salary, house, property, PGP, capital gain, IFOs, clubbing, set off, GTI, chapter 6, total income, find out the total income. Say total income in India is 10 lakhs. Okay, fine. Now, along with this 10 lakhs, that 5 lakhs will be added. So 15 lakhs. On this 15 lakhs, compute the tax. Slab rate tax, normal tax, including cess. Find out the tax. So we will get a tax. That tax divided by 15 lakhs into 100. So what we will get? A percentage of tax, rate of tax, considering this 5 lakhs. And now this rate or this percentage should be applied on 10 lakhs. That is his tax liability. So actually, if we are not considering 5 lakhs and only 10 lakhs we are taking, the rate of tax will be low. Tax amount will be low. But here, by doing the progression, the rate of tax will be more. So you have to pay some tax in addition to the normal tax. So that's the idea. This is not an exemption with the progression. Only one time they asked this question for CA final. Recently they are asking tax credit method or exemption method in a combination manner, right? Even tax credit and 91 they are asking simultaneously. So they are not asking this area. But once they asked this exemption with the progression. So remember, exemption with the progression means that foreign income will be added to total income only for finding out the rate of tax, and that rate of tax will be applied only on Indian income. Foreign income is not taxing here, but for rate of tax purpose it is considering. That's the meaning. The most popular method is tax credit method, which is mentioned in Article 23B of the DT agreement, which says income taxable in both the country. Income earned in source country and income earned in residence country, that income will be taxed in residence country, right? So in both country it will be taxable, but tax paid in source country will be allowed as credit in residence country. That will not change, because always the first event of taxation, the point of time, first event is happened source, taxation in source country, because source country will deduct TDS. Residence country taxation happens only in assessment year. So the second event happens in residence country. So always first you have to pay tax in source country, and then that tax will be allowed as credit in residence country. Now, this is the method of tax credit method. Either for tax credit method or for next section 91, we must follow foreign tax credit rule. That is rule 128 of income tax rules. That we will study. Only after studying that we can solve the problems. So what is section 91? Okay. This is what we discussed is bilateral relief, double taxation relief through agreements. So if there is no agreement, DT agreement, how the relief will be given? So that is 91. Countries with which India has no double taxation ordinance agreement. Remember, this benefit available only to residents. That is why it is known as unilateral relief. This benefit cannot be taken by a non-resident. So only Indian residents earning income from a foreign country, and with that country India has no DTA, that foreign country tax that income by applying the source principle. Here he is resident, India applied the global rule and tax that in India also, double taxation arises. No need to worry about that as there is no agreement. Come to section 91. If the condition satisfied, claim relief. This is absolutely tax credit method. 91 is absolutely tax credit method. So both are actually same. So section 91 says assessee must be a resident and he income must have accrued and arisen outside India. Remember, an income accrued in India and received in a foreign country, because of first receipt happened there, that country taxed. you won't get relief. Because who told you to receive that income in a foreign country? This income is accrued in India, right? And you should receive here also. That is Indian income. So why you received in foreign country? That is why that country is taxed. You are not eligible for relief. So income must have accrued or risen outside India. So accrued and receipt outside India. Such income not deemed to accrue or rise in India. India has no DTA agreement. Tax must have been paid in that country. See, if that income is exempted, similar to section 10 of the income tax law, in the foreign country, there is a section 10, similar to section 10. So that income is exempted in that country. But in India, it is taxed. There is no double taxation. You won't get the relief. To get the relief, income should be doubly taxed. So doubly taxed means it is taxed in India and foreign country. So tax must have been paid in that country by TDS or maybe direct payment there, or they deducted TDS, whatever may be. But tax should be paid there. So how the relief will be computed? That is Indian rate of tax on that foreign income, or foreign rate of tax, or tax paid on that foreign income in the foreign country, whichever is lower. So what is tax payable for such income in India, or what is the actual tax paid in that foreign country, whichever is lower, you can be claimed as a relief. Or in other words, Indian rate or foreign rate applied on doubly tax income, so that we can claim it as a relief. This is section 91 if there is no double taxation avoidance agreement. So this relief available only for residents. Remember, that's very important. This is available only to residents. Non-residents, this relief is not available. And foreign tax credit rule 128. So to get the relief for a tax paid in a foreign country, either under section 90 through agreement foreign tax credit method or through 91 credit, in both cases, remember, the tax must be covered in DTA agreement if there is a DTA agreement exists. So if there is no DTA agreement, that tax paid in foreign country should be equivalent income tax in India. So if you paid GST in foreign country, you cannot claim credit here. So equivalent to Indian income tax, what is the tax there? Only those taxes are eligible. If there is a double taxation avoidance agreement, there is a problem. We cannot say like that. For a DTA agreement, what are the taxes covered in that DTA agreement will be mentioned in the article, which says, okay, in India, income tax means the income tax, surcharge, cess, they will say. For Australia, taxes here means the taxes in Australia, they will make the list. So taxes mentioned in DTA agreement only will be eligible for relief. So if a tax, even though it is in the nature of an income tax, but it is not mentioned in the DTA agreement, you won't get the relief. For example, in United States, income tax is collected by both the federal government and states. Both are collecting income tax. But DTA agreement is signed between India and US federal government, or we can say Trump government. So Trump government has the authority to give credit only in respect of federal tax. They cannot give credit for state tax. So India-US DTA agreement says, for the purpose of USA, income tax means federal tax. They are not mentioning state tax. But actually a person paying, for example, 100 rupees you are paying income tax in US means 50 will be taken by federal government and 50 rupees will be taken by state government, just like GST in India. They are levying income tax. So in that situation, India-US DTA agreement says only federal tax. You won't get relief for state tax even though it is income tax. So that is why in case of a DTA agreement exists, only the covered taxes in DTA agreement eligible for relief under section 128 or foreign tax credit. If no DTA, tax equal to income tax. So the tax in foreign country, either you can pay in direct payment or TDS in such country, both will be accepted. And when the foreign tax credit will be available in India, in which year the tax paid in foreign country will be allowed in credit in India? See, you are paying a foreign tax on a particular foreign income. Okay, that foreign income, when it is chargeable to tax in India, in which year that income is offered to tax in India, only in that year you can claim a credit in India. So if the foreign income is 10 lakhs and you paid a tax of 1 lakh on that 10 lakhs, that is 10% tax you paid, but that 10 lakhs, when it is come to India, it is taxed in 2 different years. 5 lakhs in current year and 5 lakhs in next year. For 5 lakhs in last year and 5 lakhs in current year, only in India it is taxing. In that situation, that tax should also be splitted. Only 50,000 this year and 50,000 last year. Because income is offered tax in more than 1 year. So credit should also be apportioned. This will happen when there is a difference in accounting year, right? India is following April to March. There may be January to December. In that situation, there will be mismatch. So proportionate income. In our financial year, how much income is taking? Proportional tax only will be allowed. If both are same year, this issue does not arise. So year of availability of FTC, years in which such a foreign income offered to tax or assessed to tax in India. And a foreign tax credit can be adjusted against tax surcharge, cess, or even minimum alternate tax or AMD. That means foreign tax cannot be adjusted against tax, against interest on tax in India, penalty on tax in India, or late fees or something like that. Only tax can be adjusted against tax. But there is no one-to-one relation. There may be cess, here may be income tax. That cess can be used for income tax. That's not a problem. One-to-one correlation not required, but it cannot be utilized for payment of interest, fee or penalty, or credit is not available against interest, fee, penalty. If there is a foreign tax under dispute, you cannot claim now. Only after the dispute is settled and you provide the proof of that settlement, then only you can take credit. Up to that time, you have to defer. And mode of credit. So this is the main area we have to keep in mind in problem. So aggregate of foreign tax credit computed separately for each source of income from a country. So country separate we have to. If you have three different foreign tax credit and all these three are taxed in India, then credit should be computed separately. So country 1 credit, country 2, country 3. So how that will be compared? Tax payable on such income under the Income Tax Act. So what is the rate of tax for such a foreign income in India? Or foreign tax paid on such income. What is actual tax paid on such a foreign income outside India? So whichever is lower must be taken. So foreign tax will be paid in dollar or pound, etc. So that should be converted into INR. For that we have to use telegraphic transfer buying rate. As on the last day of the month preceding the month in which tax is paid or TDS is deducted. So if the tax is deducted in March in the foreign country, you have to consider 28th February what is the telegraphic transfer rate. Similarly, if the tax is paid there in January, we have to consider December 31st. So foreign tax will be paid in foreign currency. So definitely we have to convert into INR. So for that purpose, they are saying we have to take the exchange rate as on the last day of the preceding month in which tax is paid or deducted. Because if the foreign tax paid is not given in percentage, if the foreign tax is paid in foreign currency, then we have to use this calculation because we have to convert that foreign tax paid in foreign currency into INR. For that, we have to use this telegraphic transfer buying rate of SBI as on the last day of the preceding month in which tax paid or deducted. And further procedural compliance, you have to submit the, in case of TDS certificate and tax payment CHELAT, all those details and declaration should be given, then only we can claim relief. A specific form is there. If you are practically filing, you can know that form 67 should be filed, then only we will get the relief. But anyway, for computation purpose, remember what is the rate of tax or tax payable, actual tax payable on such a doubly tax income in India, or what is actual tax paid in that foreign country, whichever is lower should be taken. But if everything is given in percentage, then compare with the percentage. Rate of tax for such a foreign income in India or rate of tax in such a foreign country, whichever is lower, applied on doubly tax income, we will get the relief. So both way they are asking, but recent trend of the institute, figures, everything is given in foreign currency. So practice such a type of questions. If everything is given in Indian rupees, very easy. Proper application of FTC, that is everything will be given. Even foreign income will be given in dollar. Foreign tax actual paid, it will be given in the dollar because that is pakka practical. So there won't be a practical situation where tax paid in foreign country in INR. Only for academic purpose, such questions are given in the material. When it is come to practicals, everything in foreign currency, right? Because it's foreign country, they won't accept Indian rupee. And these are the main point you have to keep in foreign tax credits rule. And now we are going to find out how the relief will be calculated. Okay, we can go to the question. So first we are taking question number 12. Question number 12. So I am giving only two questions. All those two questions are containing everything in foreign currency, right? If you need simple questions, INR, go through your study material, right? Study material, all the questions are in INR. Very easy. But in exam, they will ask this like this type of pattern, right? And student will prepare study material and will expect for such type of problem. Yeah, they will give foreign currency. At least they can give one illustration, right? They won't do that. So Mahesh, age 50, is the CEO of Silver India Limited. So naturally we can assume it is an Indian company. Silver India Limited. Obviously Indian company. So he is a CEO in India. Okay. So his status will be resident. Definitely resident because he is a CEO. So all the time he should be here. He will be resident. 1/4/2000 since 1/4/2020. So it's very clear. 1/4/2020. So he will be a resident and ordinarily resident. All the conditions will be satisfied. From 2020 onwards, he is in India. His income in India consists of salary before standard deduction. So we have to reduce the standard deduction. See the last paragraph. Assume Mahesh pays tax under 115 BAC default tax regime. So we have to reduce standard deduction up to 75,000 rupees. 75,000 default. So 22 lakh, 25,000 rupees will be his salary income. Interest in respect of self-occupied property not available. Why? Because default tax regime people won't get self-occupied. They won't get self-occupied. So self-occupied we cannot take because default tax regime. One more issue in house property regarding default tax regime you should keep in mind. They cannot claim loss from leftover property under default. If they have loss and if they have positive income from another property, they can set off. But remaining loss, they have to lapse. They cannot carry forward or set off with other heads. Self-occupied not at all available. So that we can leave. Not available. Now, interest on bank fixed deposit. Bank FD. That is income from other source. He won't get any chapter 6 reduction. First of all, FD chapter 6 is available only for senior citizen. And default tax regime, that is not available. Chapter 6 is not available. So chapter 6 is not available. IFO is 160. He has the following income for the year under 31st March 2025 in country A. It's a foreign country. Income from business in country A, US dollar 25,000. Rent from house property in country A, US dollar 4,500. Municipal tax in respect of the above house. This municipal tax not allowed in that country. But we know in India, municipal tax, we can claim it as a reduction. US dollar 450. Dividend from shares held in country A, where dividend are declared and paid in March 2025, USD 10,000 IFOS. Short-term capital gain on USD 5,000 on sale of shares of companies registered in country A, and sale proceeds were credited in bank account outside India on 28th March 2025. So that is short-term capital gain. It will be taxable at a normal rate of tax because it is short-term capital gain, normal income, slab rate. It is not an Indian listed share or something like that. Foreign company share transferred and he is a resident, so taxable in India, normal income. So we have to convert foreign income into INR, right? So for that we have to apply the exchange rate, right? So how we will apply the exchange rate? So this you should be keep in mind. So if it is a salary income you are getting from a foreign country, we have to apply telegraphic transfer buying rate of SBI as on the last day of the month preceding the month in which salary due or paid in advance or arrears. So in which month you are getting salary due or credit receipt? Preceding month, last day, telegraph transfer buying rate. In this question, there is no foreign salary, only Indian salary, right? So no problem, no foreign salary. Capital gain. In this question, there is capital gain, foreign capital gain. Capital gain, same, but small difference. That is, they are saying transfer takes place in which year, which month? Preceding month, the last day. Last day of the preceding month in which capital asset is transferred. And then interest on securities, that is also in which month the income is due, preceding month, the last day. Dividend, last day of the month preceding the month in which declared or distributed or paid. So in this question, I think foreign dividend is there, foreign capital gain is there. Next, PGBP, last day of the previous year. And HP, house property also, last day of the previous year. All other income other than dividend and interest on securities in IFOS, last day of the previous year. What is it? TTBR, that should be taken. So in this question, that is required. Because here the income given, some income is in foreign country given in foreign currency. Okay. So short-term capital gain should be converted by using preceding, the exchange rate is given in the last part, right? So first step, so what is our question we didn't complete? Okay, India has DTAA agreement with the country A. So which section? 90. See, whether 90 or 91, remember, foreign tax calculation is as per rule 128 of FTC rules. or income tax rule 128. No change. But we have to, while claiming the relief, we have to put the section number. This relief is from regarding country A, section 90 relief, because DTA agreement is there. And they are clearly saying the provision, and the tax paid in country A in this case is source country, because he is a resident in India. So that is source country. This is residence country. Tax paid in country A is eligible for tax credit in India. The fiscal year, tax year for income tax is the same both in India and country A. So there is no confusion in that. Rate of tax is 20% in country A in respect of all income. He is getting house property income. He is getting dividend income. He is getting capital gain. 3 income he is getting from foreign company. All these 3 income will be taxed at 20%. They are not saying regarding any expenses possible in that country. That means for all these income, gross basis, he is paying 20% tax. Rent into 20%. Dividend into 20%. Short-term capital gain into 20%. That is actual tax paid there. You will get in dollar. That should be converted into INR. That is tax payable in foreign country in equivalent INR. So first we should calculate tax in foreign currency. Simply we can calculate the tax in foreign currency. Rent 4,500 plus. Remember, municipal tax paid in that country not allowed for that country's tax. So 4,500 plus. Dividend 10,000 plus. Short-term capital gain 5,000. So what is the total? 4,500. And again there is another income from business also there, right? 25,000. So 25,000 plus 4,500 plus 10,000 plus 5,000. What is the total? 44,500. So here the tax payable in foreign country will be 44,500, correct? So 44,500 into 20% into 20%. He is paying tax for all income 20%. So we will get tax paid in foreign country in USD. How much? 8,900 US dollar, right? This 8,900 US dollar tax paid in foreign country, how it will be converted into INR? By using, when he paid a tax, given in the question, income tax paid by Mahesh on 25/5/2025. So which date we should consider? 25th May, right? So 30th April. So 30th April, what is exchange rate given in the question? 72 into rupees 72. For relief purpose, we need this. So what is the tax paid in foreign country? Equivalent Indian rupee, how much? 6 lakh. 6 lakh? 4800. Okay. Now what? For the given income tax paid, okay. Compute the total income and net tax liability of Mahesh. Assume Mahesh pays tax under 115 BSE. Okay. So we are calculating, starting the computation. So first step, compute the income in India. Okay. So we are going to compute the income in India. Salary, 23 lakh minus 75,000. How much? What is the figure? 22 lakh. 25,000 salary. Okay. Now we are going to compute the house property. Always try to keep the order: salary, HP, PGBP, capital gain, IFOS. For exam, they are looking into that order, right? Try to keep that order. First is salary, 22 lakh 25,000. And second, HP. We are doing HP. So rent from house property in country A, US dollar 4,500. Regarding house property income in foreign country, to convert that, we have to use the exchange rate as on the last day of the previous year. Last day of the previous year is 31st March 2025. Rupees 71. So rent from house property 4,500 into rupees 71. That is the GAV. That is the GAV, gross annual value, because they are not giving fair rent, not giving standard rent. So this is the GAV, gross annual value, actual rent in Indian rupee. So $4,500 into rupees 71. That you have to put GAV less municipal tax paid. They are saying municipal tax paid is not allowed in that country. So what? As per income tax provision, Indian income tax law, municipal tax paid will be reduced. You will get net annual value, 30% standard deduction, interest you can claim, income from HP. So reduce municipal tax. So that municipal tax not allowed as deduction in country A, but we can claim here. That's also US dollar 450 into 71. Same, 71. So 450 into 71, you will reduce that. So you will get net annual value. Reduce 30% standard deduction. Balance, you will get income from house property in dollar. Sorry, in INR, right? In INR. Yeah, directly we compute INR. Yeah. That is income from HP. What is income from HP? Yeah. So first income is salary, right? So what is the amount of salary? You see? 25, right? HP? Now PGBP. So PGBP, that is business, country A, US dollar 25,000. Convert into INR by applying 71. So $25,000 into 71, how much? Now capital gain, that is, they are saying short-term capital gain 5,000 US dollars. So 5,000 US dollar into transfer takes place in which month? The transfer takes place in March. So we have to consider preceding month, that is February 29. What is the exchange rate? 70. How much? 50,000. And now IFOS. So IFOS dividend, US dollar 10,000. Suppose against this dividend, if they have any interest expense, we can claim. The only expense possible against dividend is interest expense. That is also up to 20% of dividend. No expense, so directly dividend 10,000 into dividend is declared and paid in March. So again same 29 February 2025 70. So 70 into 10,000, how much? 7 lakh. 7 lakh, right? So from India, there is another FD deposit 160. FD interest 160. So we I think considered all the income, right? There is no chapter 6A 115 BAC default tax regime. So this is a total income, and all these incomes are incomes taxable at a slab rate. There is no flat rate. So straight away go to 115 BAC and apply the 115 BAC rate. So what is the 115 BAC rate? Up to 3 lakhs nil and 3 to 7, 7 to 10, 10 to 12, 12 to 15, above 50. So nil, 5, 10, 15, 20, 30. So what is the total income? 54 lakh 11,285. Income crosses 50 lakhs, right? There will be surcharge, right? So 10% surcharge will be applied on the tax surcharge. First find out the tax, then add 10% surcharge, add 4% health and education cess. You will get tax liability in India. This is not the final answer, just the tax. See, up to 15 lakhs, what will be the tax? 1 lakh? 1 lakh? 40 or 50? 40. 1 lakh 40. Up to 15 lakhs, 1 lakh 40, right? So out of 54, 11,285, balance amount 30%, right? And then 10% surcharge, then 4% cess. So what is the tax? $13 lakhs, 13,385. Is correct? No, you have to take surcharge and cess. Yeah. After surcharge and cess, final answer, final tax. 15 lakhs, 2,000, 5, 1, 3. Find out the rate of tax. 15 lakh 2,513 divided by 54 lakh 11,285 into 100. How much? 27.76% is the rate of tax, average rate of tax in India. So now we are going to find out the double taxation income and the relief we are going to find out. So they are saying first step, what is the tax payable on such income in India? So So such income means here what are the income from that foreign country, that is only is HP, and another one is PGBP, capital gain, not the entire IFO is this 7 lakhs, right? So these are the foreign income which are taxed in India, right? So after claiming standard deduction only this is taxable, right? So the income taxable out of the foreign income in India is this much. So what is the total of this? 30285 into 27.76, right? 27.76%. That is known as tax payable in India on such a foreign income. So what is that amount? 840 90 096. Okay, 8,40,096, right? So 8,40,096 is the tax payable on such a foreign income in India, or rule says tax payable on such income in the foreign country. So in the foreign country, we just calculated what is the tax payable, that is here 6,40,800. 6,40,800. So whichever is lower is 6,40,800. This is a relief under section 98 as per rule 128. Claim the relief. Balance is the tax liability of the assessee. So what is the tax liability? One lakh 99,000. It round it off, then 300. 199 300. So this should any doubts? So this should be the computation. If the foreign income and the foreign tax paid, everything is given in foreign currency, then this should be the application, because this is the provision of rule 128. What is the tax payable on such income in India, or tax payable in foreign country for such income, whichever is lower. So only 6,40,800 we can claim the relief. So exam purpose, if they're asking a question on double taxation relief, you must write the reasons for that also. So you must write a theory on this double taxation relief and all those things. You must write the theory. Yeah. Our tax liability. What is the tax payable? No. The tax liability is 15,02,513, right? From that we have to reduce relief 6,40,000. So remaining figure is not correct. Yeah. What is the remaining figure? 8,61,713. So round off to 710. Got it? So I will show you the printed solution. So what is the name of that SSC? Mahesh. Yeah, Mahesh. So salary 10 to 75. So property, country business income, then short term capital gain 350, 54,11,285. So final answer 8,61,713, which will be rounded up to 710. So if the foreign income given in INR, and foreign tax paid is given in percentage, this is not the mother. So in that situation, you can practice the questions in your study material, right? So that won't be asked. And if there is multiple countries, the relief should be computed country wise separately. Indian tax rate applied on country A foreign income, what is the tax? Compared with the actual tax paid in country A, whichever is lower, country A relief. If there is country B, what is the rate of tax for in India for the income applied on country B? Then compared with the tax payable for such a foreign income in country B, whichever is lower, country B relief, then country 3 relief. So like that we have to do. There may be one country with which India has DT agreement, another country there is no agreement. Then with the DT agreement, you will apply section 90 and this relief, and 91 relief of the other country not. Now there is one more question, question number 13. Next question, last question in DT relief. Mr. Ram, a citizen of USA, resides in San Jose in USA since 2006. He is a non-resident since assessment year 2008-9. He works for Exim Corporation, a US-based company. He came to India on 10th January 2024 to visit his aged parents. Actually, he is a foreign citizen. He came in January 2024. He could return back on only 31st January 2025. He was permitted to work from home in India by his employer. The details of his earnings and withholding tax during the said period is as given below. So Ram visited India, is a non-resident since assessment year 2008-9. For the current year 2024-25, he visited in January 2024 and remains in here up to 31st January 2025. That means our previous year starting from April 2024. From April 2024 throughout the year until January 31st, he was in India. So his residential status, if he apply, he will satisfy the universal test 192. So he is a resident, but he will not satisfy the additional conditions because last years he is not here. Additional condition is out of 2 years, out of the last 10 years, he must be resident in India, and last 7 years he should be in India for at least 730 days. So he will not satisfy those additional conditions. So his residential status will be resident but not ordinarily resident. He will be a resident, but he will be a resident but not ordinarily resident. So that is the first point we have to keep in mind regarding residential status. So if he is resident but not ordinarily resident, every Indian income will be taxed here. Only 2 foreign income will be taxable. What are that 2 foreign income? Foreign business income if the business is controlled in India. Foreign professional income if the profession is set up in India. Any other foreign income cannot be taxed in India. Only these 2 foreign income. But all Indian income will be taxable. He is working here. So since he is rendered services in India, if he is getting salary elsewhere in India, it will be taxable in India because service is rendered in India. This is the issue. He is working here, but his employer is US company. He is getting salary there, but working here. So it's an Indian income. It will be taxed in India. So because service is rendered in India, accrued in India. So months, January 24, we not required. We need to take only from April 24. Salary $6,250. All figures in dollar. April. And the federal tax, tax deducted, or we can say TDS deducted in that country, US. Federal tax 1,600, state tax 420, social security tax 420, and then they are giving the directly the telegraphic transfer buying rate as on the last day of the month, immediately preceding the month in which the tax has been paid or deducted. So directly we can take that 70 each column. What is the exchange rate given? That is direct. So as we discussed, only those taxes covered in double taxation avoidance agreement will be covered. So usually in a double taxation avoidance agreement with the US, federal tax only be covered. State tax is not covered. So social security tax is not covered. So we have to consider for double taxation relief purpose, we have to consider only federal tax. Don't consider state tax and social security tax. That is not eligible for relief. And April till January is getting like that. Now he has also earned fixed deposit interest in USA on 30th September 2024, US dollar 200. Tax deducted in US dollar 20, and on 31st March 2025, US dollar 220, tax deducted is US dollar 22. So see, this FD interest cannot be taxed in India because accrued in US, received in US, so it cannot be taxed in India. Because his status is resident but not ordinarily. If his status was resident and ordinarily resident, then global income is taxable. That can be taxed here. But here his status is resident but not ordinarily. Only 2 foreign income can be taxed, foreign business and foreign profession. But this is FD interest, cannot be taxed here. So that is not at all taxable. You have to put a note on that. As per Article 2 of Double Taxation Avoidance Agreement, Article 2 defines the taxes covered, that is Article 2. So Article 2 of the DTA between India and USA is the taxes covered for credit card. Federal income taxes imposed by Internal Revenue Code IRC, but excluding say social security taxes. So state tax also won't be available, only federal income tax. Even social security tax also not eligible. Return of income for assessment year 25-26 was filed on 25th August 2025. He's an individual. So the due date for filing ITR is 31st July. So there is a delay in filing ITR. Usually if there is a delay in filing ITR, a person liable for 234A interest. If there is tax liability, he will have to pay 234A interest. You are required to compute tax payable, if any, by Mr. Ram. Assume that tax as per 115 BAC is opted. He is under default. Advise Mr. Ram the procedure involved to claim foreign tax credit. That is that procedure. Form should be filed, proof of challan should be submitted, all those things. First part is computation. So remember, he is resident but not ordinarily. But service is rendered in India. So salary, even though received in foreign country, even though received in foreign currency, if service is rendered in India, salary deemed to accrue or arise in India as per section 9, subsection 1, subclause 2. So his salary is taxable in India, but FD interest is not taxable. So we can compute the salary. Throughout the month, the salary is uniform, 6,250. From April 2024 till March 2024, January 2025, his exchange rate is same, 72. So simply apply 6,250 into April to January. How many months? 10 months, right? So 10 months into, so $6,250 into 10 into rupee 72. That is salary in INR. How much should be the salary in INR? 45 lakhs. Round figure, 45 lakhs. Standard deduction. It's BAC, right? 75,000 standard deduction. Balance is a salary, taxable salary. On that, find out, apply the tax as per 115 BAC slab rate. You have to apply 115 BAC slab rate. So up to 15 lakhs, you can take 1 lakh 40, and for the balance 30%. You are calculating relief. For calculating relief, you have to take the total federal taxes paid. Only, no, 6250 is salary. Tax is, federal tax is 1,600 per month. So 6,250 salary into 10 into 72. So Indian salary income you will get 45 lakhs, right? Yeah, reduce standard deduction 75. So income from salary or total income 44 lakh 25,000. So tax that is 10 lakh 58,200 including cess, correct? Surcharge not applicable. Simply find out the rate of tax. Again, no other income. This is the tax liability. This is the rate of tax. 10 lakh 58,200 divided by 44 lakh 25,000 into 100. You will get the rate of tax in India or tax liability. 23.5. Okay. If you apply 23 point that percentage on 44.25 foreign income, again same amount will be get because there is no other Indian income. Usually we are doing rate of tax in India applied on foreign income. So here foreign income also same. So tax payable in India is 10 lakh 58,200 compared to tax paid in foreign country. Tax paid in foreign country, you should take 6,250 per month multiplied with rupees 70. Whether that rate is uniform? Uniform? 72. 6,250 into, 6,000, not 6,000, 1,600. 1,600 into 10 into 72. So you will get the tax payable in foreign country or tax paid in foreign country on such income. How much? 11 lakh 52. See, 10 lakh 58,200 or 11 lakh 52,000, whichever is lower. So entire 10 lakh 58,200, which is the lower, you can claim relief. So tax payable is 0. We cannot claim any refund, right? So tax payable will be maximum 0. That is why they are saying whichever is lower. There is no possibility of negative. So 10 lakh 58,200 is the relief. So that relief can be claimed. So tax payable will be nil. As his tax payable is nil, 234A interest is not applicable, even though return is belated, right? So no 234A interest. And procedure is he has to give certain documents, that is following statements or documents to be submitted. US tax paid, proof of tax paid in the US country, certificate or statement specifying the nature of income and the amount of tax deducted in form number 67 that has to file. So before the end of the relevant assessment year, he has to furnish this form. So this is the solution. Okay. So double taxation relief is also over. Last part of the study material in this chapter, they are putting a BPO taxation. That's only a theory. If a foreign company gives some of their operations into India as a BPO activity, there is no tax liability for that foreign company because BPO work is carried out by Indian entities. So Indian entities has to pay tax as per residence. There is no liability for foreign company. But if the foreign company, instead of making business process outsourcing to India, if they start a subsidiary or branch in India and doing the work it here, if it is a branch in India, that will be treated as permanent establishment. Whatever income is earned through that branch from BPO activity, that will be deemed to accrue resident and taxable in India. So some theory is there regarding BPO. So major area is relief 91 and 90, and sometimes they may ask some theory. And there is one more area where there is a very rare situations where a person can become resident in both countries simultaneously. Source country is resident, here also resident. India is also resident, he is a resident in foreign country also. Because say for example, another foreign company have a residential status rule of 182 days stay. India have 182 days stays. Total 365 days. If a person equally divided 182 days he stayed in India, correct 182 days of the remaining year he stayed in another country, he will become resident in both countries. If a person is resident in both countries, we will call it as dual resident persons. Dual residency is very dangerous. We cannot further proceed. We have to break. So we have to decide in which country he is resident. For that purpose, we should go to the double taxation avoidance agreement. In double taxation avoidance agreement, there is a tiebreaker rule. So as per the DTA agreement, normally the tiebreaker rule is if an individual is resident in both countries, then we should see in which country he has permanent home. So that permanent home country should be treated as resident, other country will be treated as source country. Because both country residents, we cannot apply DTA agreement for relief. Always there should be one residence country, other one will be source country. So if both resident, find out in which country he has permanent home. Permanent home means it should not be an owned home, some sort of a permanence in residing, right? It may be a rented house also, no problem. Permanency should be there. He should be, when he visit that country, he will stay in that place. So that is permanent home test. If he has permanent home in both country or no permanent home in both country, then this test will not be applied. Go to the second test. So go to the second test they are saying is we have to see the his habitual abode. So habitual abode in both places or there is no habitual abode, then go to the center of vital interest. So that is actually habitual abode. See, that is also not available. Then go to the third test, in which country he is a citizen. Both country he is citizen or not citizen in both countries. So both country citizen is actually illegal. Suppose both countries he is citizen, then there is no other way. Home test failed, habitual abode test failed, citizen failed. Then the last test is only other way is MAP. What is MAP? Mutual Agreement Procedure. Give an application to Indian Ministry of Finance and here they are their ministry. In between ambassadors talking and finally they will get into the resolution. That is MAP solution. So this is the way a person if becomes a resident in both country, tie break rule. So they may ask a theory question from that area. Because without breaking this rule, we cannot apply DTA agreement because always one country should be resident, other country should be source. It's a connecting factors. Otherwise, we cannot claim relief, right? Because tax paid in source country allowed us relief in residence country. If both country residents, how relief will be computed, right? So that is a tiebreaker rule. That's a theory area you have to keep in mind. So these are the main areas you have to finish. Okay, you have to see through the last moments, and tomorrow we will go to the domestic taxation area. Morning we will start with capital gains because a lot of amendments and those things are there. So capital gain we will start. Then we will move to the PGBP and set off. Then straight away to assessments, company, firm, LLP, AMT, all those topics. Okay. So morning at 9 o'clock, right?